Good morning, everybody. Good morning. Good morning and welcome to the 40th Annual International Banking Seminar. On behalf of President Goldfein and the entire Inter-American Development Bank Group, a warm welcome to Chair Raghuram Rajan and all members and friends of the Group of 30. For 40 years, the G30 has been a unique forum, bringing together leaders from central banks, finance ministries, academia, and the private sector. And for 10 years now, the IDB has been proud to host this gathering, bridging global debates with the perspectives of Latin America and the Caribbean. At a time of change and uncertainty, these spaces for candid exchange are rare and more necessary than ever. This year's program captures the big questions of our time: the global economic outlook, how we manage slower growth, high debt, and geopolitical risks, the emerging global architecture, how institutions like the IMF, the WTO, and finance ministries adapt to shifting trade rules, inequality, and climate-linked pressures. And these conversations will shape whether the decades ahead bring greater cooperation or deeper fragmentation. In 40 years, the G30 has seen its share of transitions: the 1980s debt crisis, the Plaza Accord, the rise of global capital markets, the global financial crisis, the pandemic. Each moment felt defining, even destabilizing. So while today's uncertainties may feel different, history reminds us that cooperation, adaptation, and strong institutions have always carried us through. Since we are at the Inter-American Development Bank, the House of Latin America and the Caribbean, let me briefly bring in our region. The LAC region faces familiar pressures: low growth, high levels of inequality, and frequent and punishing natural disasters. But it also holds solutions the world is seeking, from the Amazon's role in natural assets, to critical minerals for energy security and technology, to food production at global scale. This is why the role of multilateral development banks is so important. Our institutions act as bridges, bridges between our regions and the world, and between the public and private sectors. We are built to intermediate, both in capital markets and in knowledge transfer. Today, MDBs are working together more than ever to align strategies, mobilize capital, and create the conditions for investment and reform. In a fragmented world, these bridges between borrowers and lenders, between regions, between sectors, between institutions themselves, are what allow us to turn potential into progress. For 40 years, the IBS has provided a trusted space for the world's top economic voices. For 10 years, the IDB has been honored to provide a physical space for that conversation. I hope today's discussions on the global outlook and on the evolving architecture of our international system help us chart a path that is pragmatic, cooperative, and resilient. Thank you, and let's begin.
Thank you, Jordan, for that very kind welcome. It's good to be back at the IADB. As Jordan mentioned, they've been our partners for 10 years. This is the 40th seminar that we're holding on international banking. So on behalf of the Group of 30, let me welcome all of you to this meeting. Of course, this comes at the end of a week of important meetings that many of you have been part of. And I think all of us look forward to our impressive set of panelists, as well as the many central bank officials, finance ministry officials, private sector leaders, officers of multilateral institutions, journalists, as well as members of think tanks and academics who are in this room today. Now, just a word about the Group of 30. We were established in 1978 as an independent global body comprised of leaders from economic and financial sectors, both from the public sector as well as the private sector and academia. What we aim to do is to deepen understanding of global economic and financial issues, and to explore the international repercussions of decisions that are taken both in the public and private sectors. I believe our role is especially important in these difficult times when we can help foster mutual understanding and dialogue between countries. Just as advertising, you might have seen a bunch of reports out there. We have published 3 reports this year, one on the Federal Reserve's Monetary Policy Framework Review in April, on carbon pricing and markets, enabling efficient emission reduction in September, and just last week, the past and future of money, new technologies and economic risks. The last report, which was shepherded by Ken Rogoff, was in response to a popular IBS panel last year that you may remember with Shaktikanta Das, Andrew Bailey, and Augustine Carstens. All these reports are out there. Please take one. And let me end with just some logistic issues. Today's seminar is an invitation-only event, but it is on the record. Members of the press are present here with us and watching online. So that's just a note to our panelists. We do have a full agenda, an opening panel on the global economic outlook, followed by a panel on the emerging global architecture. I think each panel intends to take questions from the audience. This is a special tradition of G30 events. Thank you, and please join me in welcoming panel 1 to the stage. Thank you very much.
Good morning.
Good morning. Well, also from my side, let me welcome you. It's been a very busy week for everyone in the room, but I think a particularly busy week for the 3 friends that are here on the podium. They need no introduction, so I'll really be very, very quick. We have a fantastic combination here of thought leaders in finance. And let me start with Kristalina Georgieva, who's the Managing Director of the International Monetary Fund. We have also Christine Lagarde, the President of the European Central Bank, and Andrew Bailey, the Governor of the Bank of England. Kristalina, I want to start with you. You've been hosting the world this week, and you, as always, kicked off the meetings with the World Economic Outlook. Maybe talk a bit about, where do you see the world going? And what were your main takeaways from your meetings this week? You must have had many, many of them, so I know that it's been a busy week. So very thankful for you taking the time being here with us today.
Oh, thank you for inviting me, and wonderful to be with such a strong representation of monetary policy making right next to me. We started the week presenting the outlook. It is telling a very interesting story. Our projections today are worse than they were 12 months ago, but better than they were 6 months ago. And why is that so? Because in April, there was a major shock to the global trading system that has gotten uncertainty up, up, up. And at that time, when we were here, the concern was that the global economy is going to slip into recession. In fact, the fund was one of the few at that time saying, we see worsening of the outlook, but no recession in our baseline. And I remember answering many questions from the media. How come we are not seeing a recession? And we didn't see a recession then, we don't see a recession now, because the world economy is performing quite well. Economic activity is relatively steady across the world. When we look at the development since April, 3 things stand up. First, the trade war didn't really happen. Yes, we have a major change in trade policy in the United States, but the rest of the world has chosen not to retaliate, and so far, that may change, but so far, countries are preferring to trade under the rules we have established over the decades. The United States tariffs also have landed in a better place than they seem to be landing in April. In April, we calculated 23% tariffs. Now they are nominally 17.5%. In reality, what is collected based on exceptions is somewhere between 9 and 10%. Of course, much more than it used to be. Before April 2nd, they were 2.7%, but less bad. And we see a very interesting phenomenon in regional settings with more appetite to reach agreements that have been in the making, but on a slow cooker, and now they are much more attractive. The EU is reaching out to many parts of the world. Regions that should have traded more with each other, like the Gulf, ASEAN, Central Asia, they're saying, wait a minute, why are we not taking advantage of proximity and build stronger links? So the trade story is not as terrible as we feared it may be. The second thing that became very clear, and we did a chapter in the WIO on that, is what countries have done to make their economies more resilient in terms of policies and institutions. And emerging markets in particular, many of them now have much stronger fundamentals than they had around the global financial crisis. They have independent central banks, many of them. They have fiscal councils. They have strong reserves. And the message, very straightforward, the message that, as the head of the IMF, I embrace wholeheartedly is fundamentals matter. Good policies, good institutions give you a good payback. And the third very interesting thing is private sector. Private sector acted quite well, pre-positioning when there was news about tariffs. Massively, imports moved the pain somewhere in the future. Supply chains are being readjusted. And again, a very interesting thing, when we look at the last couple of decades, many countries that used to have the state heavily involved in the economy, taking on itself economic activity, the state has moved out, private sector stepped in, and private sector at the time of shocks is more adaptable, more agile, more resilient. So this determines what we see in the outlook. We have downgraded vis-a-vis October last year only by 0.1% from 3.3 to 3.2 for this year, 3.1 next year. And we are looking at an economy that not overwhelmingly performing, but still holding okay. What is, however, troubling? And there are many things that we can talk about, but I want to focus on three. The first thing that is troubling is that the level of growth is not very impressive, and debt is very high. And what is mostly troubling about slow growth is that it is due to low productivity. With the exception of United States and a couple of other more dynamic economies, productivity simply is not growing in a way that would provide a boost to growth. So that is a big worry, because when you have very high level of debt, that means that economies are actually in a tough spot. And the level of debt likely to reach 100% of GDP public debt by 2030 is something that we talked a lot when we were at in the room of the meetings. The second thing that is troubling is that because of this strong productivity push in the United States and the big bet on AI the US is making, we're seeing finance moving towards the US with a high concentration. Some 2/3 of global financial assets are in this country. And the big growth of investment is in one area, in the area of artificial intelligence. It is a bet. If it comes to fruition, it would be fantastic. But what if it doesn't? Or what if it does, but so slowly that it actually does not quite justify this level of investment? What if we are to see abrupt change? When you look at stretch valuations, I mean, full disclosure, I'm paid to worry, so I look at stretch valuations, good thing, but it is also a risk. And the third thing that is clearly top of mind concern are global imbalances. The fact that over the last years, excessive imbalances have increased quite significantly. And what it means is that we have, and they are concentrated in a small number of big places. We have excessive savings in China. We have excessive deficit in the United States. The EU is a very interesting story because the EU, yes, it pops up on this excessive imbalances graph that we would show, but within the EU, the main reason there was this imbalance was Germany. Germany not spending enough. Germany is changing that. And actually, is there any German in the audience? I love to ask.
No, but on the podium.
So I can, well, of course. My message is bravo, bravo, bravo. Because what Germany is demonstrating is that imbalances can be addressed. It is a matter of will, and that mostly political will. So this story of imbalances is one that we will have to continue to look into for a variety of reasons, mostly domestically, how policies can be managed. And of course, we look at the world. We have 191 members, and the part of the world that in my heart, I feel most for are fragile states, vulnerable middle-income countries, low-income countries with high level of debt. They are getting squeezed by behavior policy choices of others. They are takers, they are not makers of these choices. Development assistance is going down. And the only bright news here is that we saw one big conflict addressed in a very systematic manner in Gaza. Could we see more of this? Is to be, obviously it would have significance. So when we look at you asked me what the meetings did, incredibly encouraging behavior of policymakers. I have rarely seen so much constructive engagement as I have seen in all the rooms I was sitting in this week. It may be because uncertainty is so high that there is no space for theatricals. We have to see together how to manage through this uncertainty. It may be because now many countries realize that what they took for granted international cooperation that helps us do better, we should not take for granted, we should work for. And we came, the three big priorities that popped up, not surprisingly given what I told you of the story of the week. One, get your own house in order, especially your fiscal house. Cannot postpone that very, very much. Two, make sure that you create opportunity for innovation and private sector and entrepreneurship. If there are regulatory obstacles, red tape, get rid of those. And number three, when there are imbalances, these imbalances cannot be left to fester. Message to us at the fund, please speak up of what you see. Be candid. There is this phrase that some that like the fund use, brutal truth teller. Maybe because I have a soft grandmotherly heart, I don't like the brutal thing too much. But I tell my members, we would deliver for you tough love. And that is what we ended the meeting with.
But maybe just before I go to Christine, maybe just add a bit more. You usually get mandated to, contribute to bringing the world forward and, helping the global economy to come on a more sustainable path. So, more concretely, what is it that the fund at the moment is really putting out as priorities?
So, we're working on three very big reviews that have significance for the way we operate. One is the comprehensive surveillance review. In this review, our aim is to, for example, be better in addressing imbalances, to be able to look at national level, bilateral surveillance, global level, multilateral surveillance, but also in between, regional surveillance. We do a very good product, the Euro area Article 4 consultations. Why not similar product for ASEAN, for the Gulf Cooperation Council? We have a very significant review of the conditionality, program design and conditionality. How can we make the fund more effective in preparedness and prevention of crisis? And what can we do with programs to enforce what I started from? Sound fundamentals matter. We also have a important review of the financial sector assessment programs. Clearly, in this changing world where we have non-bank financial institutions, we have stable coins, we have to make the FSAP work even better for the membership. And one thing that everybody asks us for, help us to cooperate in this more fragmented world. And actually, what does it mean? It means that we have to lean forward even more to bring groups of countries together and provide what everybody says, you cannot fail us on this, provide the objective information that is for everybody to see the world and themselves from the same vantage point.
Thank you. And we'll get in the next round, we'll get a bit more into the financial sector and some of the things you mentioned. Christine, Managing Director already mentioned that Europe, I found, we talked about it very briefly, the mood around Europe too pessimistic around the meetings. Give us your vantage point from your current responsibilities, where you see the road ahead and the outlook for the Euro area, for Europe at large.
I'll be very happy to do that. Can I do it from the podium?
Oh yeah, sure,
Is it okay?
absolutely.
Because I have some numbers, I don't want to get them wrong.
Very good.
Thank you. So good morning to all of you, and I'm delighted to see some friends in the audience. It's lovely to be back. I've spent the whole week talking about monetary policy, financial infrastructure, framework, the regulatory environment, and I decided today, given the quality of the audience, to go back to my roots, to be out of my depth, and to talk about a topic that, Kristalina, thank you so much, you introduced perfectly for me, which is those global imbalances. And given that this is the weekend of the Austin F1 Grand Prix, that maybe some of you will watch, I thought I would use a couple of car analogies, and I hope you don't mind me doing that. So, global imbalances, that will be a big topic, and we count on the IMF to study it in depth. And we know that this is going to be a G20 key theme under the US presidency. This has been announced, and it's loud and clear. And the discussion so far has centered predominantly on the United States and China. But Europe is also in the spotlight, suspected of pursuing unfair trade policies. And there is no denying that Europe is a major player in trade. We are by far the largest, most open economy in the world. Here is for Europe. But, and I respect those numbers and they're correct, if I'm to believe what the IMF has analyzed, together the euro area and China account for roughly half of the world's current account surplus, about half each, while the US represents 3/4 of the global deficit. So let's look under the hood, my first car reference. Because those headline numbers do not fully reflect the underlying economic reality in Europe, nor do they capture the adjustment that is already underway. So the IMF numbers are correct, the analysis is correct, the diagnosis is correct, but we have to go under the hood. So there are 3 points, among others, that I would like to clarify. First, among the 3 major economies, Europe is not a key source of global imbalances, and its contribution has been steadily declining. In a globalized trading system, bilateral balances never tell the whole story, but they do matter for the political economy of trade and trade tensions. So when I look at the euro area largest surpluses, it is not with the United States, it is not with China. The largest surpluses are with the UK, with some of the non-euro area Central and Eastern European countries, with Australia, with Canada, with Hong Kong, with Mexico, with Brazil, with Turkey and South Korea, widely spread. The euro area runs a deficit of almost 150 billion euros with China, which has widened by around 10% this year, by the way. Trade with the US is broadly balanced. A goods surplus is offset by a services deficit, and much of both, you're going deep under the hood now, much of both is driven by US multinationals. Let me explain. Around 30% of our bilateral goods surplus reflects exports by European affiliates of US multinationals. Conversely, those same firms account for roughly 90% of our services deficit. Let me give you the example of the pharmaceutical industry. A pharmaceutical company typically pays for intellectual property that originates from where? The United States, and supply its product manufactured in generally one particular country in the euro area. I will not mention which one, but those products are then supplied to the United States. In addition to that, Europe's overall current account surplus has been declining. If you look at the numbers back in 2018, that number was about almost 4% of GDP. By the first half of this year, it had halved, down to 2.1%, and everything we see is going to confirm that this will be the number, or even a bit lower, for the whole of 25. If you look at our other colleagues, the 2 major economies, they're going in the opposite direction. China's current account surplus has risen from 0.2% of GDP in 2018 to 3.7% in the first half of this year, and the United States' current account deficit has widened from 2.1% to 6% of GDP during the same period. So let's put the hood down, and let's now look at the drivers, second analogy, of Europe's surplus, and we see that they are fading away. Kristalina alluded to one, and I will mention another one. By the way, imbalances are not inherently negative. When imbalances are created by improved competitiveness, driven by genuine productivity, they benefit everyone. But when they are sustained by distortionary policy choices rather than by fundamentals, they risk becoming a zero-sum game. Now, there are two main forces that in the 2010s and following actually pushed Europe's current account into surplus. One, strong performance in global markets, partly driven, by the way, by real exchange rate compression, benefiting in a not so homogeneous way the euro area countries. One of them benefited particularly, and fiscal consolidation at home. But since the pandemic, these two drivers have faded and have been reversing in some corners. Euro area exports are now increasingly under pressure, particularly with intensifying competition from China, which has moved up the ladder. Since the start of 2022, the euro area has seen, wait for that number, a real appreciation of around 32%, 3-2, against China. Now, why is that? Just renminbi euro? No. It's, of course, stronger nominal exchange rate, no question, but it's also price rising faster in Europe, and for some sectors, price declining in China. First driver. The second one, which is also fading for the reason Kristalina has articulated, fiscal policy, which will also play a more supportive role in the years ahead. This is, of course, especially true for countries that are going to increase their defense investment, and this is certainly the case, big way, by Germany, where major military and infrastructure investments are underway, which are just beginning to have an impact, but which will be rolled out over the next 3 years in a very significant way. So Germany is using its balance sheet and its capacity to borrow. So the average fiscal deficit in the euro area is expected to stand around 3.2% of GDP over the next 3 years. So policies in Europe are contributing to the rebalancing, and this, I would argue, stands in sharp contrast with development elsewhere. In China, export growth has been strongest where? In sectors where the domestic demand is weak. When you look at the increase of exports by China, you will see visibly that it is very strong in energy and energy components of all sorts, and in vehicles, particularly electric vehicles, where demand at home is weak. Meanwhile, the main driver of the global current account deficit is still the US fiscal position. And I don't know what you see, but we're not seeing little attempt to rein that in. So there is a third main driver, and this one we're not going to do anything about it, because we all suffer from it. And that is aging. Our demographics is not going to help, because we are an aging part of the world. We're not the only one, most are. And as a result of that, aging brings less investment and more saving. So that will continue, and based on the IMF assessment, 1% of current account gap would completely be justified by demographics. So, 3 main conclusions. First of all, coercive trade measures against Europe will not help the US external imbalances. Additional volatility, uncertainty, anxiety, and constant changes in trade policies, especially of coercive nature, are not going to bring this sort of comfort and willingness to consume. I'll spare you the details of the studies that we're conducting, but in Europe, and based on consumer surveys and based on the studies that we do, more volatility, more uncertainty, particularly in the kingdom of trade, brings about more savings by consumers, particularly when they're aging. Second, the US would gain more from pooling resources with its allies than trying to force activity back home. It would actually make sense, and this would be perfectly Ricardian. We have a case in point at the moment. The rare earth debate, which is heating, is obviously an area which would justify perfectly that alliances be stronger than going it alone. And the third conclusion that I draw is that Europe should continue to pursue measures to strengthen domestic demand. This will make our economy more resilient, less exposed to external shock, just in case. I'm going to quote a study by the IMF, which has reviewed the equivalent of tariffs that we impose on ourselves by having internal barriers. On goods, 45%. On services, 110%. Now, if we just clear just half of that, we would gain massive capacity to trade amongst ourselves, not necessarily with the rest of the world. And our analysis indicates that an increase of just 2% of intra-euro area trade could fully offset the export losses to the US that might result from the current tariffs. So to sum up, I think it is inaccurate to characterize Europe's external surplus today as a key driver of global imbalances. It mainly reflects economic factors that are already reversing and demographic realities that we simply cannot escape. The world should view Europe as a stable and trusted partner, one that is already doing its part to ensure that free trade remains a win-win proposition. This applies above all to the US, where our historic relationship enables both our economies to develop the areas of comparative advantage while avoiding inefficient reshoring of activity. We should leverage this partnership and deepen it in new areas such as rare earth, rather than eroding it through hostile actions or rhetoric. But if the US continues to see Europe as an adversary in trade, and if China continues to pursue distortionary policies, we have strategy that we can pursue to shield our economies. And most importantly, we must, and we can, unlock the potential of our continent-sized single market and turn it into a far more dynamic source of demand for European companies. So we have the ways, and they could certainly be the will to do so. Thank you.
Christine, I think you're absolutely right. We need to work on the internal barriers to trade among European countries. But you said something very important, which I think is usually missing in the picture about global imbalances. We also could work on our own capital markets and banking union, because what you rightly identified, the service account is very much dominated by Europeans consuming exports of financial services by US financial firms, and most of European funds have an overweight on US exports. So if we strengthen the banking union and the capital market union, that's two additional levers that maybe you say a few words where you see the
I call it
project.
my 3S.
Okay, please.
So I have to remember what the first one. Oh yeah, the first one is single market. As I said, 45%, 110%, thank you to IMF for having produced those numbers. It's in your face. Why would you impose tariffs on yourself? So single market for real. Number two, saving and investment unions. This is the capital market union, banking union, European investment products that are truly attractive, and possibly transformation of pension scheme in various European countries. The Netherlands, Klaus Knot has arrived, I see him, is a case in point where this can be done. And the last S is simplification. So we are not, I think it should be very clear that the European Union is not sort of static with its massive framework of regulatory environment and rules over rules over rules. I think there is a clear understanding that simplification has to happen, that we have to facilitate the life of those who want to invest in Europe. Equally, we have respect for the rule of law, and we have respect for institutions. And it's important to have a framework within which you know where you are navigating, where you're investing, when you're employing. But we have to go through that simplification diet, imposing it on ourselves and doing it sooner rather than later.
Very good. And I think exactly what you said before, the fact that Germany is now changing its fiscal direction will help also.
Agent of change, Germany, who would have thought so?
I, for one, but let me bring Andrew in. Andrew, and you can, welcome to use the podium as well for your introductory remarks.
Yeah, I think I'm going to have to break these debates up about Germany. Look, it's a great pleasure to be back at the seminar, and I'm going to say actually that I want to try to convince you at the start that we didn't plan all of this in advance, but I'm actually going to go back to my roots. I'm also going to pick up themes that both Kristalina and Christine have developed. Kristalina in the case of growth and slower growth and low productivity, and talk a little bit about trade in the same way that Christine did. But the roots point for me is that the sheer mark's actually 40 years since I first joined the Bank of England. And before that, I was an economic historian, so I'm going to actually go back to a little bit of economic history throughout this. And the reason is that, to start with, is that in recent years, the nature of the shocks, the economic shocks that we face, has changed. I think when you're in monetary policy making, the natural territory is to respond to shocks to aggregate demand and its components set against a pretty slow-moving supply side. That picture has changed quite dramatically. We've seen much larger, much faster-moving supply shocks. The examples are staring us in the face in recent years: COVID, Russia's illegal invasion of Ukraine, tariffs. And these shocks pose very challenging questions on what are their economic consequences. What impact has COVID had on longer-run labour supply? What impact are tariffs having on price setting? These are very big questions that we face. But as Christine just referred to, there are even deeper supply-side shocks at work affecting structural parameters, and I think two are important. One, Christine has already highlighted, which is the negative labour supply impact of long-run population ageing. The second one, going back to Kristalina's opening comments, is the lower rate of productivity growth in many economies, the UK included, over the last certainly 15 years. To pull that together in the UK, using the UK as an example here, over that period of 15 years, the potential growth rate of the economy has declined from around 2.5%, which it was in the 20 years before the last 15 years, to an average of about 1.5% in this 15-year period. So that's a 1% fall in potential growth, which I will come back to in terms of its impact. But the largest contribution to that decline, picking up Kristalina's point, has been productivity growth, lower productivity growth. And it's very important to understand the impact of this. For those of us in monetary policy, it affects the speed limit at which the economy can operate, accepting, of course, that the challenge during quite a bit of that time has actually been not so much to restrain demand growth to a lower speed limit, but to raise it up to a lower speed limit. But let me come back to this 2.5, 1.5 point and add a very simple illustration. It's using, again, the UK economy. It's a very admittedly naive counterfactual, but I think it makes a point. So imagine that during the last 15 years, the economy had run at a 2.5% speed limit, the one that it had been running at. So supply and demand both grew at 2.5%. Imagine that we hold fiscal policy constant to what it was. If we do that, the debt to GDP ratio would now be 82% instead of 96%. And the official projection for 29-30, which is the outer point, would be 79% and not 96%. And that is a big difference. So the point I want to draw out, which really just goes back to what Kristalina was saying, is that the denominator, the growth rate, matters. Put it this way, slower growth makes economic policy making much more difficult. And as Kristalina and Christine have said, a lot of what we've been talking about this week has had that background theme to it. So let me come back to a bit of economic history now to illustrate this, because I'm going to take 4 lessons that I think we can draw from economic history. Now, first of all, economic historians would be surprised at the lesser attention paid to the supply side, because over the longer run, growth has come from the supply side. There was a very long debate in the earlier days about the British Industrial Revolution, and the answer was supply did it. So we should obviously pay attention to the supply side. Secondly, supply-side growth has never really been sustained over time. It comes in waves, and the real dial-moving changes are so-called general-purpose technology innovations, starting with the steam engine, moving through electricity, going onto the internet. And it hasn't always come quickly, though I think there are good reasons to think that the speed of delivery of it is increasing. But if you go back to electricity, it's reckoned to have taken 40 years from the point when Edison first wired a light bulb to electricity to it showing up in productivity statistics. And Edison himself is always supposed to have said over this length of time, I didn't fail, I just found 10,000 ways that it didn't work. So I say that because I'm going to come on to AI in a moment. You know, we are still at the experimentation with AI, and experimentation and persistence is crucial. The third lesson from economic history is that the supply side growth across sectors of the economy is typically very uneven. Again, there was another long debate on the British Industrial Revolution as to whether and why aggregate growth was slower than it in the later part of the 19th century than it had been, and it was. There was also a debate in the Industrial Revolution itself as to whether it was even growth or it was uneven growth. And the answer actually was it was pretty uneven growth. It was in the leading sector particularly of cotton textiles. So an economic historian would not therefore be surprised by recent evidence from the US economy of slow overall growth in manufacturing productivity outside the tech sector, and a concentration in a few computer-related industries which are growing rapidly against that background of a slightly different picture across the manufacturing sector outside those computer parts. By this stage, an economic historian is probably talking about déjà vu. The fourth point I want to draw out is about different growth models and what, again, we learn for today. The Yale economic historian of the past, Bill Parker, used to teach economic growth in European history around three theorists of the past, who I'm going to come back to: Thomas Malthus, Adam Smith, and Joseph Schumpeter. And I'm going to finish my remarks with just a few comments on the significance of this for today. But briefly, just to make the point about these three. So let's start with Malthus. So Malthus symbolized the theory that population growth had the potential to outrun food supply and thus limit economic growth. He was wrong. And he was wrong because productivity in agriculture increased and freed productivity capacity to enable the Industrial Revolution. But I'm going to come back to a point as to why I think it's useful to come back to him. Adam Smith represented the idea that the extent of the market limits the division of labour, with higher productivity coming from economies of scale and specialisation, the famous pin factory. And the key element of Smith's thinking, going right back to what Christine was just saying, was that in a larger trade area, you would get more productivity growth and thus a higher potential growth rate. But what Smith didn't have, and the other classical economists didn't have, was to incorporate into their thinking the last leg of the argument, that continuous, though fluctuating technological change and innovation, financed by the extension of credit, would raise potential growth through raising productivity growth. Coming back to my point about general purpose technology. That's the leg that is first associated with Schumpeter. So what are the lessons that are relevant here today? And I want to draw them out. First, going back to Malthus. I'm going to make a point about Malthus in reverse. As Christine said, we face populations that are on average ageing. So rather than labour supply outstripping other elements of the supply side, as Malthus said, food, we face it declining in a way that reduces the support for potential growth. So that puts more stress on my 2.5 to 1.5 point. Second, let's go to Adam Smith. Tariffs contradict the Smithian growth model, as do other measures that restrict trade. And I'm going to give a personal experience of this issue at work. For what is coming up to nearly a decade, I've been very careful to say that I take no position per se on Brexit as a public official. It was a decision of the people of Britain. It's our job to implement it. But I quite often get asked a second question: what's the impact on economic growth? And as a public official, I have to answer that question. And the answer is that for the foreseeable future, it's negative. But over the longer term, there will be, because trade adjusts, some at least partial rebalancing. Why do I give that answer? Because that's the Smithian growth model. Making an economy less open restricts growth. Over the longer term, you'll get some adjustment. Trade does adjust, it does rebuild. And all the evidence we have from the UK is that is exactly what is happening. And the same argument holds for the world economy and tariffs. So third, let me go back to the 2.5 to 1.5 point again. If we take account of the impact of ageing and trade restrictions, we're really putting our chips on the Schumpeterian growth model. We're putting our chips on investment. We're putting our chips on general purpose technology. And AI looks like the next general purpose technology. So we need to work with it. We need to ensure that it develops appropriately and well. I'm going to now try to convince you finally that I wrote these remarks before the Nobel Prize this year was awarded to Joel Mokyr, whose work, in fact, I've actually just drawn on Joel Mokyr's work earlier, but I did write it before he was nominated. I am, of course, very biased on this point. I'm delighted. His work is on the prerequisites for lasting growth, demonstrating the importance of scientific discovery interacting with practical knowledge in a society that welcomes technological change. That's exactly what the Nobel Academy has said this week. And to Philippe Aghion and Peter Howitt for showing how technology progresses through the innovative dynamics between competing firms. So let me finish on this point. There is nothing inconsistent with a point that I've seen actually a few articles on, saying, is it inconsistent that we think that AI is going to be a breakthrough in productivity, with also saying that it may, in the current circumstances, be a risk to financial stability through stretched valuations in markets. And I'm just going to make this point. Those two are not inconsistent. It may well be that we get some market correction, but it doesn't undermine the fact that AI, in my view, is likely in addressing this slower growth issue that we have, slower productivity growth, and the consequences of it, which all three of us have been talking about, that it is actually the best hope we have, and we really do need to do all we can to foster it. Thank you.
Thank you, Andrew. And I'd like you to also stay with you for a second. I think you rightly reminded us, going back to Ricardo, that autarky is not the best reference point and that trade is actually welfare enhancing, and putting tariffs out is kind of moving you a bit away from that equilibrium. Kristalina also rightly said we haven't really seen any big impact on growth because there has been no retaliation yet, I guess. And then a third point, you are in London, one of the global financial centers. You have most of the American firms, most of the financial institutions are in London. Do you fear that this escalation that is possible about trade conflicts spilling over to capital markets, spilling over to service markets, that is something that that we're likely to see? Or are you hopeful that we can, as Kristalina tried to say, this is not a big number yet in effective terms? Can we maintain and retain that as a narrow discussion around adjustment, a one-time adjustment in tariffs, and then the world moves on? Or are you concerned a bit more that this will continue to be something that goes on?
Well, I think it's interesting. I mean, I'll offer two thoughts which don't necessarily go in the same direction, but I think they're both relevant. I mean, first of all, I think it's interesting, of course, that the tariff issue is now focused almost entirely on goods. Of course, tariffs are, I mean, you need other tools, in a sense, to address services, but I think it is interesting that the attention is entirely on goods. But on the other hand, I don't think that's the end of the story. I mean, I do think that there is a real risk that, if we fragment the world economy, we affect capital flows. We know that actually, of course, capital flows and trade flows are deeply integrated in that sense. So the idea that you can affect one and not the other, I think, is too much of a stretch to think that we can really rely on that happening. So I do worry about it in that sense. Whether there are explicit measures taken in the area of services and financial services, I don't think gets around the fact that we could still see there is a risk of big consequences in that field in terms of capital flows.
Please feel free to come in, Kristalina or
Well,
Kristina.
I am convinced that we are not going to go back where we were before the developments in this year, but also they actually have been bubbling up for some time. So the question is where we are headed. I would expect to see more regional trade integration. I would expect to see this giving an impulse possibly to more financial integration. And I think that in a sense it may be a good thing that we are now forced to take steps, transform economies in a way that maybe we would have not done it. I look at the EU, and Christine is so right. If Europe completes the single market, it would present not only a better performing economy for its own citizens, but it would present an anchor for many in the world that would like to work more under leadership that comes from Europe. The big if is Europe going to complete the single market union? We had the Draghi report a year ago. Then we had a stock taking of how far Europe has gone in implementing it, and it came up with 11% implementation. I am obviously keen to see that there is a speeding up, but if it doesn't happen, if the 3S that Christine talked about are slow to happen, it would be an opportunity missed for Europe, and it would be an opportunity missed for the world because of the signaling effect a strong economy in Europe that is based on rules, it is based on working with others, it's an open economy, would send to the world. The second thing I expect to see, unfortunately, there will be more hiccups and trade stuff that we don't like. And some of it we can even foresee right now. When one big economy, China, is shifting trade that would have gone to the United States, exports that would have gone to the United States, to the rest of Asia and to Europe, that inevitably creates a risk of actions taken by other countries. And this is why our message to China is, it is absolutely existential for what you claim you want, a world of open trade, that you, China, increase domestic demand and you direct domestic savings more towards your own people. And by the way, you have so much you can do. Services, you can increase. So that kind of conversation around policy changes that need to be taken is not one in which we have the privilege and luxury of time. It has to move a bit faster if we are to have a more positive development. Can I say, I'm abusing the fact that you gave me the floor, so I'm holding it, but I want to just share with you one simple observation. I spent about half of my professional life as a professor in Bulgaria, in a world in which one part was closed to the other. Our countries were behind an iron curtain. And in these days, I could have never imagined that I would be sitting in this room as the head of the International Monetary Fund. Impossible, right? Until the world changed. Change is unstoppable. We have to realize that, and the unthinkable can happen. And the question is how to brace for this change, but also how can we steer change in the direction that works better for as many people as possible. By the way, the other thing in these days, when I was professor in Bulgaria, I was certain that I would retire at 55.
Tough.
Keep going. Keep going. We need you. We need you to continue your work. But you rightly mentioned the Draghi report. It's a great report for Europe. Let me tell you, we're working on the user manual, what governments now need to do. Christine, I know you're passionate about that.
Yeah.
Please come.
Because I want to go under the hood again. Kristalina is right. 11% of the prescriptions have been completed, delivered, or on the ground. But 60% of the prescriptions are in progress and through the legislative process that we have to go through. We are a country which respects the rule of law. We are a democracy, a democratic setting, and we don't have the European executive order that would just deliver instantly under exceptional circumstances. It doesn't work that way. So I think that there is no doubt, there should be no doubt, that there is now a European drive and a European momentum to deliver on these 3S. We have to keep it up. We have to constantly get little kicks in the back, in the butt.
Christine.
And the 11% number is one of those things.
Yeah.
Now, one additional point that I would like to make to supplement what Kristalina emotionally told us about her life before. You should all know that on January 1st, Bulgaria joins the euro. And yes, great. So
And that
it
is a very
proves, it
important-
proves the point that number one, change
Yes.
happens in spite of your will. And second, that when there is a political determination and democratic forces, which is the case. I know it's hard in Bulgaria, in so many other places, by the way. Yeah? Let's not look east and think, oh, poor guys. Okay. But it happens. And the economic convergence has taken place. The inflation levels are at the right level. The anti-corruption laws have been passed. It did happen in Croatia over the last few years. Croatia has been a member of the euro area for the last 3 years to its success and our joint benefit. So, you know, I do bring a message of hope. I'm sorry.
It's a two-hander, please.
Christine, I just have one message
You'll
on
be
this.
there on January 1st, I know.
One message on this one. Vite, vite, ma petite.
Yeah,
Europe,
of course.
move faster.
No, but vid, Bulgaria.
And I think, you know, we already discussed, I want to come back to Andrew, we already discussed what has, for example, caused the change in Germany. And I can tell you, 100%, external pressure on the European Union, the unlawful invasion of the Ukraine, American tariffs, help move things forward, because Europe cannot on the sideline when it's under pressure. And pressure helps create speed, because just sort of facing adversaries and adverse conditions doesn't really help. You need to then move to implementation, how you get to a better place. And Andrew, you indicated that it takes some time to adjust, but if there's pressure on trade, we will see new trade arrangements take place and trade diversion. So please, both come in. I want to have a discussion amongst you.
No, but before Andrew has the floor, and he should have it a lot, you should explain what it means for Germany to decide to invest in military equipment and what change of mind and culture it has been.
Yes.
Oh, it has, and it's not done. It is still something that is debated in the nation when it comes to the detail, whether we talk about conscription army, whether we talk... So the details are not yet done, but I think the new direction of travel is pretty clear. Germany, I always used, again, a car metaphor. Germany was a perfect backseat driver in the European Union. We now accept we need to join the driver's seat.
Yeah.
And that's basically the best car analogy that I can use. Details are unclear. We have to know how to get... You know, and actually I used to describe with another car analogy Europe. Europe is like a bus journey with 27, but the problem is you have 27 steering wheels in the bus. What we need to
will never die.
What we need to do is to really decide direction of travel and then choose one driver. And for me, because I'm a European, that's the European institutions. Please. But let's continue. Andrew, you want to come in and add?
Yes, I mean, I think the essence of the point is that if you make an economy less open, in the first instance, you will reduce productivity growth, you will reduce actual growth. And that's, as you said, that's the lesson we get from David Ricardo, from Adam Smith. Over time, you will get some, trade is dynamic, so you will get some adjustment. The UK is looking obviously for trade agreements. None of us can say how quickly that happens. None of us can say how completely it happens. But over time, you get adjustment. And I think if you then map that to the world economy and to tariffs over time, it will have the same. If you make the world economy less open, it has that effect. Now, we do, of course, have another factor going on here, which we've talked about in a lot of meetings in recent years, which is you do, of course, have to take on board what the lessons we take in terms of the need for resilient supply chains and what we learned from COVID. So there are other factors at work here, but still, if you make the world economy less open, it will have an effect on growth. It will have it will reduce growth. Over time, again, you will get adjustment to the patterns of trade, but that does take time because that's a structural thing.
Absolutely. And since I'm no longer an active policymaker, I want to add one dimension. thinking about the US as a prime market where you pay in terms of goods for the privilege of having access to that market, you shouldn't forget, as Christine said, you also have the privilege of being the total global magnet for capital flows from the rest of the world, and they come basically with no strings attached at this moment. So for me, since you're all, I just want to end this round on the stage and then open up. You're all managing financial institutions, and Kristalina rightly says, I'm paid to worry. So you're all risk managers. What is the number one risk? And briefly, please, what is the number one risk that you worry about, say, in financial markets at the moment?
Well, I think and I think we can sort of sum up many discussions we've had this week on this subject. So please. So I think we face a number of big themes here. The first one is that we have seen over the last, the post-financial crisis period, a shift in the relative mix of bank and non-bank financing in the global system. I would say I don't think we should be surprised about this because in a way, the measures that we put in place post-financial crisis were designed to address weaknesses in the banking system, and we shouldn't be surprised at the consequence of them. I think it's appropriate that we have the debate now about the role, about the precise nature of the regulations that we have and what they've done. But we've all made this point many times this week. We should not be losing the anchor to financial stability. We cannot lose that, and we should not be throwing the baby out with the bathwater, therefore, to use a phrase. But we do have to spend a lot of time looking at non-bank finance of that sort. And one particular issue is the huge change in intermediation in core markets. So take government bond markets, the best example probably. The nature of intermediation in government bond markets has changed hugely in the last 5 to 10 years. There is a much bigger non-bank presence, there is much more leverage in these markets, but they are still being financed heavily by the banking system. So the nature of the links between the banking system and the non-bank system has changed in that sense. I'd like to think it's more robust because of the changes that were made, but we have to scrutinise that very carefully. The second part of this mix, we have to lift the lid on private finance. Now, I was saying this before any of the sort of events of the last month or so, because it is an opaque world. Again, it has there are close links between the banking system and that part of the world. There are close links between the insurance system and growing links between the insurance system. They're not wrong. But it's our duty to lift the lid and see what's going on. And we've obviously had a few events events that are going on at the moment where we are having to ask the question, are these one-offs, or is it the canary in a coal mine? And I'm afraid I have said a number of times to people, look, if you go back to before the financial crisis, we spent time looking at subprime mortgages, and we decided until it happened that they were not systemic. They were not big enough to be systemic, and we were wrong. Let's be honest, we were wrong on that. Now, I'm not saying, therefore, that the answer is the same again, but it underlines why we have to lift the lid and do the scrutiny. And the third one I'd mention is the whole growing world. I mean, we've already mentioned stablecoins, but the whole growing world of digital finance. I'm going to put a plug in for, again, because Raghu said it, for the G30 study that was published last week that Ken Rogoff led, which a number of us were involved in. All G30 studies, of course, are an excellent pieces of work, let me be clear, but it's a particularly excellent one because I was involved in it. It's a very good one. It sets the issues out, and there are very important issues here about what I think between having a clear notion of the division between the world of investments and the world of money, and what it is to be in the world, what it means to be in the world of money, and particularly that you have to have a short nominal value to maintain trust in money.
And kudos, because Klaas is here, and he just had a very nice farewell celebration in Amsterdam, and I apologize for not being there. But the FSB, which basically both of you are now in charge, and he has been in charge for so many years, is doing a lot of work on that. And
yes.
I think that will lead us to a better place. Let's, I guess, open up for...
You missed quite a party that day.
I did, I knew it. But I was in Singapore, and to your car analogy, I was actually at the Temasek meeting around the Formula One.
Oh, okay.
So I apologize for that. Let's open up, please. When you have a question, raise your hand. We have microphones in the room. Please mention your name. And could I ask members of the press corps not to ask a question what the next interest rate move will be, please? Roger.
Roger Ferguson, Council on Foreign Relations. A question about AI, one to each of you. So, Kristalina, you talked about how your heart goes out to certain sets of countries. Is AI going to make that inequality across the globe better or worse? Or more importantly, how can we use AI to make it less an equal world? To Andrew, policymaker and economic historian extraordinaire, what does supply shock from AI suggest to you about neutral interest rates? Big question that is much debated and has been here in the U.S. at the Fed, I believe. And obviously to Madame Lagarde, a pleasure to see you. Europe and its role in AI. You know, most of the large language models are being developed here in the U.S. or in China. Don't hear much about Europe in this new engine of growth. And so how do you think about it? Thank you.
Well done, Roger. You covered it all. Good. Please, we'll start. Andrew, you were the first to address, and then we go to...
So AI does hold tremendous potential for developing economies to address problems cheaply. Agriculture, increase productivity because you get access to weather information, you can direct your goods in a more informed way. Healthcare, education, connectivity, this regional integration that I'm talking about. But for this to happen, there are two prerequisites. One, infrastructure, digital infrastructure, access to electricity, and two, the ability to finance the elements for that transformation to take place. In other words, access to the apps that are going to make it a story. So where are we today? We have developed at the IMF a AI preparedness index. We are asking this question, are countries ready? And we look at four things. We look at infrastructure, digital infrastructure. Second, skills and labor market flexibility. Third, innovation, how innovation goes from theory to practice, penetrates the economy. Four, regulation and ethics. And then we rank 174 countries. You wouldn't be surprised who is at the top. Advanced economies and some emerging market economies, like not just China, but emerging markets with cheap energy, like the Gulf countries. They are up. Who is at the bottom? Low-income countries. And when you look at what is the biggest difference, it is in the first category, in infrastructure. So my main message here is, if we do not want to see AI turning into yet another driver of divergence, then there has to be concentration, with a sense of urgency on making infrastructure, digital infrastructure, available everywhere. In my all days before I came to the fund, there was a study done that said that to have internet connectivity on the continent of Africa, it would take $15 billion. $15 billion is nothing, but it would take organization, logistics, determination. I have a lot of respect for Ajay, because Ajay is concentrating on access to electricity. Make sure that everybody has it. So you're asking me, is it going to be better or worse? We would only know if we are to be more advanced, is this fundamental obstacle removed or not? And I can tell you that at the fund, we are urging attention to that. So when we do Article 4 consultations, when we look at regions, we are saying this is happening so rapidly that not even moving slowly makes you go back. Big risk for increase in divergence, but it is not given. Ajay would say forecasts are not destiny.
Thank you. And I echo your optimism. I'm actually seeing startups out of Africa being successful on the European continent, which is very, very reassuring. And the AI will catapult that even further. Andrew.
So to Roger's question on the neutral rate, Christine, set out the argument for why an aging population shifts the saving investment balance towards saving relative to investment, and that, other things equal, that would lower the neutral rate over time. Now, if we have a big investment-led AI growth, that would shift that back.
Exactly.
How much to be determined. So that would be the sort of the offset to that, in the sense of increasing the demand for investment relative to the supply of saving. Now, I'm not saying it would raise the neutral rate, but if you've got a trend decline in the neutral rate caused by the aging point, you could see an argument for offsetting that. I suppose the second other thing I would say is, of course, there's then the interesting question about what it does for the labour market over the long term. I have to say, I mean, if you again draw on economic history, you go back in Britain. Actually, a colleague sent me a brilliant quote from Queen Elizabeth I, who got very worried about the impact on the employment of her subjects, as she put it, from a knitting machine. I mean, we've always had fears of mass unemployment, and they haven't materialised. But I do, however, there's a big however here, which is that to avoid that, you have to have a lot of investment in training, education and skills, and even more so in a world where you're dealing with something like AI, which is obviously a very highly technical thing to have. So I still subscribe to the view that I don't think you get a big. I think it's people working with AI more than AI replacing people. But there is a big demand for investment in people to get there.
It's fair to say that we don't know yet with new technologies. I'm always flabbergasted by a famous quote by August Benz when he invented Mercedes car. He predicted very limited growth because there was a shortage of professional drivers. There you go. Christine, please.
Roger, thank you very much for your question. Lovely to see you. We are on the receiving end at the moment, but we have the talent, we have the savings, and there is something in between the two that is not working. And when if you look at COVID vaccination, who was behind it? 2 Turkish immigrants who went to Germany, got seed money from KfW. Former president of KfW is sitting with us here. Hello, Joachim. But there was not enough money, not enough scale. They had to go to the US, and Pfizer took over.
Exactly.
Second, there's plenty of savings. The Europeans are saving like crazy. At the moment, it's about 15%. So that savings does not find its way where the seed money, the second round money, the third round money, and the proper capital market IPOs are taking place. So we need urgently, as Axel was saying, we need to move that fast. When I hear the German Chancellor say, we need in Europe one single stock market, one single supervision, that means a lot. Now, how that will materialize, how it will take place, how this will, how it will work out, I don't know. But I want to go back to one of the points that Kristalina made. Time is of the essence. My big worry, and many of you are nodding because, the Europeans are going to be so slow. You might be surprised, you never know. But what I'm concerned about is that our young people around the world have this expectation of instant gratification, of instant satisfaction and response. Economic processes, cycles, life does not produce that. If I learned anything in the last 6 years, is that things take time. Whether you call it the lag time, the impact of what you decide, that doesn't happen instantly. How we can bridge that gap of massive expectation of young people who are animated by populist views that are propagated in a very nice way, and how we policymakers with a lot of goodwill are trying to engineer. How we close that gap is going to be a big, big test of success.
I can just add one sentence. What you're seeing in Europe, the European Silicon Valley is between London, Paris, Berlin, Amsterdam. And there is no lack of talent. There's no lack of ambition, and there's no lack of capital. You're seeing a lot of capital flow the other way, rather than in mature markets. In seed funding, the largest amount of money is coming from the United States into Europe. We just need to add European money to it.
But savings go there, and then the seed money goes, it doesn't make any sense.
So I think we can do better. I agree with you.
Okay.
Please, we had one more question that we can have, and Jacob here in the middle had his hand up before. Can you get a microphone to Jacob? Please, thank you.
Thank you very much. Kristalina, you started the week with the sentence, the situation is better than feared and worse than needed. So in other words, those who listened, half of them came out very smiling, well, it's better than we feared. And some were very concerned, it's worse than it could have been. And my concern is, have we normalized the situation in which economic policy instruments have become weaponized? Have we normalized the situation in which tariffs that we all know are the bad policy for most objectives? Did we say, well, we'll give up, there was no retaliation, that's okay, or should we be more outspoken about it and say, no, it's not the world that we want, and it's not the world that will lead us anywhere, especially if you are dreaming about completing markets, completing reforms, and all the rest. Thank you.
And we have very little time, so if you can be short. It's an electric car we're driving, Christine, and the clock says we've got 3 more minutes to go. So Kristalina, we start with you.
We know we should not be accepting policies that go against interests of people. We always need to remember policies are for people, they shouldn't be against them. But we also should not bury our heads in the sand and pretend that the world hasn't changed, because it has changed. It is a multipolar world, it is a more fragmented world for a reason. Different players in this world have different interests. And the way they square these differences is not straightforward. You just look at one thing, the Security Council, completely paralyzed, impossible to take any meaningful action. So it is a different world, and we should be, what can we do? We can just show what is better for people and amplify this message as loudly as we can, and that we do.
Andrew, please.
I think one of the other important points that we've had this week is we've now got 2 arguments going on really about trade and imbalances. One is what I call a macroeconomic argument. You set it out very well actually in saying, China needs to increase its household consumption. And then there is a microeconomic argument going on, which is about industrial policy. And there's a danger that these 2 are like ships in the night. They're passing, but they never merge. And I think one of the things, and I know we've discussed this a lot this week, is, and I think, thank you for taking this on. We've got to sort of, in a sense, bring these 2 things together, because otherwise this argument never lands. And the other thing I would say, which is very closely related to that, is that we've then also, therefore, got to bring the IMF and the WTO into this, with the WTO coming alongside, because we've got to help to rebuild the world trading system, so we can't just do it sort of in one place and not the other. It's absolutely critical to my mind that we do this, and we've got to get behind this work on imbalances and address this, because otherwise, over time, the effects of a less open world economy will tell.
Christine, please, if you want to add anything.
I have 26 seconds. Charger is almost out, right?
Yep.
I would say that we're moving to a different equilibrium, where there will be different trade players, relationships. My very sincere wish is that the wars that we have around, and Ukraine is a case in point, it's not the only one, can benefit from the same spirit and momentum that the ceasefire in the Middle East has produced. And I hope all that holds and progress towards peace. I've seen enough situations when I was in Kristalina's position where we really restored things, it was getting better, and then the war comes and hit. That's the worst that can happen, and I just want to wish for the best.
That's a good reminder for all of us. Thank you. Mm-hmm. The main reason you ask a German who lived 10 years in Switzerland to chair a panel is to end it on time. Mission accomplished. Thank you for your attention.
man, the light here is awful. Thanks. So I came to work with Annabelle.
Oh, you did.
I am chief economist for the IDB. Yeah, we had met at Jackson Hole.
Yeah. Brilliant. I think I remember. I was looking.
Welcome back. Welcome back. As we begin this conversation, I would like to take you back 40 years to 1985, a year that marked a turning point, the beginning of the G30. Globally, 1935 was a moment of transition. As was mentioned by Managing Director Kristalina, the Cold War was shifting. Developing countries was dealing with the debt crisis. The Plaza Accord was reshaping currency markets. Europe was working on the Single European Act, as President Lagarde mentioned, which was eventually finalized the next year. For a teenager in Costa Rica, this was the time of back to the future, money for nothing, we are the world, and can't find this feeling. And I'll test you later for the knowledge of all these important trivia. Today, 40 years later, we gather with leaders around the world and ministers to reflect on how these struggles and transitions shape the world economy and how we see the world evolving in the next 40 years of the G30. With that in mind, I'm honored to present our distinguished panelists. They don't need a lot of introduction. We have Gosi Okonjo-Iweala, which I just pronounced in Spanish, so hopefully it works. Director General at the WTO, Rania Al-Mashat, Minister of Planning and Economic Development and International Cooperation in Egypt. I was also Minister of Planning, the best minister there is. Class Knott, founder of KK Economic Advisory. I did not get that invitation, but hopefully next year. And Professor Maurice Osfeld. I know he says he's retired, but he is from whom I learned everything I know about international economics. He is a senior fellow at Peterson Institute for International Economics. And so we will start by having each of our panelists give some opening remarks. Director General first.
Well, thank you so much. And good morning, everyone. I've been told that we should speak for 10 minutes, so I've tried to tailor my remarks. And there are so many wonderful familiar faces here, and you would have heard some of these things before, so hang on. So it's a pleasure to be here with you and with my fellow panelists this morning. The global trading system is facing its worst disruption in 80 years. We all know it. And the impacts are visible. Unilateral actions have undermined trade rules. The system is, as I say, battered, bruised, but it is not broken. It's still standing. In that regard, there's some good news. Trade has been resilient, almost surprisingly so, as illustrated by the WTO's very recent forecast last week, and I'll share that with you. In it, we estimated that global goods trade was on track to grow by 2.4% this year in volume terms. That's well above the 0.9% growth we estimated after the August tariffs came in, but not as good as the 2.7% we forecast pre-tariff. The latest upgrade is due to three main factors: massive front-loading by U.S. importers, the AI investment boom, and resulting demand for heavily traded goods like semiconductors, computers, servers, and manufacturing equipment, and the fact that trade has continued to grow, this is the third aspect, with the rest of the world. South-South trade, including outside China, is growing. The rules-based multilateral trading system continues to provide a stable core to world trade. 72% of global goods trade, according to our calculations, still operate under core WTO most favored nation tariff terms. We also see and welcome the reinvigoration of bilateral and regional trade negotiations around the world, which outside of the US's framework agreements, they're outside of this, we see as complementary to the multilateral trading system in the emerging trade architecture. So we welcome them. Most of them are based on a WTO platform. They are not competing, they are complementary. The resilience of trade thus far is good news because international trade matters to a wide range of economic outcomes. Nevertheless, the outlook for next year is somewhat less optimistic, as we are forecasting 0.5% growth for global goods trade, driven by a wind down in inventories, backloaded impact of tariffs on prices, and continuing uncertainty. In fact, uncertainty clouds the forecast, and I think we have to learn to live with uncertainty for the foreseeable future. There are both upside and downside risks to this forecast. On the upside, we could see continued growth in AI-related trade, due to this investment boom, if it's not a bust or a bubble. And then if we couple this with South-South, growing South-South trade, we could see an upside. On the downside, we could see increased protectionism arising in some instances from diversion of China trade to other parts of the world. As US-China trade continues to contract, we're seeing this trade moving elsewhere, over 40% to Asia, 25% to Africa, 8% to Europe, down 3%. This is interesting, down 3% to Mexico. But we are watching this and monitoring what is happening. And our members are calling us. We are asking them to use the basket of tools available at the WTO. But at a time when trade and trade policy is under tremendous stress, it's worth reminding everyone why trade matters. Trade and macro stability go hand in hand. I said yesterday at the IMFC that you cannot have macro financial stability if the trading system is unstable. We have decades worth of evidence that trade integration has been disinflationary. The London School of Economics' Francesco Caselli and his co-authors have shown that falling trade costs reduce macroeconomic volatility for most countries. The case is straightforward. Openness to international trade allows countries to diversify sources of both demand and supply across the world. That reduces exposure to domestic shocks, hence lowering income volatility. But trade's benefits go well beyond that. By enabling greater specialization, scale, and competition, and by helping technology and ideas spread from one place to another, trade is a key driver of productivity, growth, and purchasing power in advanced economies as well as in poorer ones. Between 1995 and 2022, real per capita incomes in rich countries rose by about 50%, and falling trade costs accounted for roughly 1/10 of that increase. Researchers at Maurice Peterson Institute for International Economics estimate that the gains to the U.S. economy from international trade added up to $2.6 trillion in 2022, equivalent to 10% of annual GDP. In Western Europe, WTO research finds that trade cost reductions between 1995 and 2020 boosted real GDP by 3.6%. Trade cost reductions played an even bigger role in emerging and developing economies, where incomes increased by over 140% between 1995 and 2022, albeit from a lower base. Using external demand, inputs, and ideas to turbocharge growth has helped lift over 1.5 billion people out of extreme poverty. The share of the world population in extreme poverty fell from 33% in 1995 to 9% in 2024. And even if you extract China from that data, it still holds. So trade has been a strong, if underappreciated, shock absorber through the storms of the past 15 years. Crisis-hit countries could rely on markets elsewhere to absorb surplus supply, allowing growth and development to rebound more quickly than would otherwise have been possible. If we look ahead, trade and open global markets will be essential to reignite global growth. But to do this, we must solve problems within the trading system itself. And as I frequently noted, I do share successive criticisms from successive U.S. administrations, criticisms of the WTO and of the trading system. I don't agree with everyone, but I agree with a lot. Even if we don't like the unilateral actions, we must listen to some of these criticisms. Dissatisfaction with how WTO rules have been implemented or perceived gaps in those rules have fueled resentment about unfair trade practices, industrial policy, subsidies, unlevel playing field, inadequate, and developing countries have complained of inadequate support to integrate them into world trade. The much-treasured consensus decision-making system we practice at the WTO has been practiced as unanimity in decision-making, and this gives de facto veto power to each member. This has made the organization less flexible than it should be and introduced difficulties in negotiating new rules and agreements. In addition, the WTO rulebook has not kept up with the pace of technological change. A further set of problems comes from the emergence of overdependence in a system designed for interdependence. An excessive degree of dependence on the US for market demand on the part of some countries and on China for critical supplies is fueling resentment and political tensions. It's also creating vulnerabilities. Relying on a single country, let's take Chinese Taipei, for over 90% of the world's cutting-edge semiconductors is not a recipe for global resilience to shocks. So all this adds up to a strong and urgent case for reforming and modernizing the WTO. And I do want to take a minute to thank President Taman for a brilliant Per Jacobson lecture in which he also laid out, and Raghu, thanks to you, this issue of reform. We think it's urgent in considering, and members really have to act. In considering the reforms, members have come to recognize that they're a body of WTO's rules and functions that are valuable and essential to maintain an orderly trading world for the business community. I can name some of these agreements. They're not very sexy. Customs valuation, intellectual property, and the standards. They are the plumbing of trade, okay? And you don't think of your plumbing until the pipe breaks and floods your basement. That's like WTO. People take it for granted. They don't think of it. It's like plumbing. But if it breaks, believe me, you will have floods in trade. So in short, I'm coming to the end. The WTO reform agenda revolves around three things: identify and sustain what works, reform what does not work, modernize and reposition the organization to take advantage of new opportunities in digital, services, and green trade. So ladies and gentlemen, the work on reform, must also be buttressed by work on global imbalances. Every economist recognizes that reform of trade rules alone cannot solve deficit and surpluses. Work in key economies such as China to stimulate domestic consumption and the US to curtail fiscal deficits will be essential to help solve the problem. It was so helpful to see at both the G20 and IMFC meeting that finance ministers and central bank governors urged the fund to work on global imbalances and urged them to also collaborate with the WTO as they look at the macro issues. We can look at the micro and sectoral aspects of this. Let me now conclude. Status quo is not an option for the present trading system. Reform is urgent. It requires courage and tremendous political will. We are trying to muster that courage at the WTO. When and not if we succeed, an exciting future awaits trade, and it's within our grasp. One with flexible coalitions of members within the WTO able to make new rules to take advantage of fast-growing services, digital and green trade. A future with a steadily greater role for South-South trade and developing economies. One in which supply and demand are more widely distributed and hence more resilient to shocks, and many fewer people left on the margins of trade. Thank you. Thanks.
Minister Al-Mashad.
Well, thank you very much. It's a pleasure to be here, being back in Washington, initially as a student of the international cooperation and international economics, then working at the IMF, now being both a customer as a country that borrows from the IMF, has strong relationships with the World Bank, but also thinking about, with everybody who's here, how does the international financial architecture look like? What should it look like going forward? And maybe just reflecting on Laura's question, if we go back 40 years ago, for students of economics, that was the lost decade. We are here at the Inter-American Development Bank. We know that at that time there was a lot related to programs being externally designed, prioritizing fiscal consolidation, not necessarily looking and taking into account the human capital aspect, growth, development. There was always a sense that debt continues, and no matter how many times there are financial packages, still the challenges continue. 40 years later, we take a look and we find that despite the different context, still the rising debt burdens continue. They're amplified by different types of shock, maybe climate, geopolitical instability. We still have constrained fiscal space. There are growing inequalities, and the international financial system sometimes still struggles with delivering timely, adequate, and equitable support. But nonetheless, when we take a look at the details, we will find that many words are changing, and many words are being translated into certain actions. For example, we're moving from conditionality to country ownership, which is extremely important, emphasized once and again, and also being in the psyche of the discussions and the negotiations when we are talking with different IFIs. There's also the concept that we're going from uniform programs to differentiated approaches, and therefore there's not one size that fits all, and that is something which is also quite significant and important when we're taking a look at what's happening today. And then the concept of trying to move away from just crisis response, but looking at structural reforms that push the long-term trajectory so that the inequalities, what President Tarman always talks about, the human capital element, so that we can safeguard and become resilient against future shocks, is extremely important. And then the definition of global public goods. Increased climate vulnerabilities, what happens when countries are trying to spend to be able to protect not just at a national level, but at a global level. How can we redefine together global public goods so that there is taking into account and internalizing a little bit when we are talking about debt sustainability analysis on what countries are doing to protect not just themselves but others. And then inclusive governance systems. How can the voice of the South and the voice of emerging markets be more evident and more within the governance structure of the different IFIs that we look at. And there are several initiatives that look into that. I just take the Bridgetown initiative as one example, but we take a look at, for instance, how the G20 common framework is evolving, how we can look at the use of SDRs more in order to push for developing economies, the financing, increasing the financing that is needed, and also trying to take a look at how the shocks themselves can be used in order to create shock-proofed economies. When we take a look also at the different programs that the World Bank and the IMF are looking at today, from those who are actually engaged with them, we find more systemic consistency between the different messages. Today, I mean, these annual meetings, you find growth and jobs being repeated, whether you're at the IMF or at the World Bank. But what might be important is that the engagement with the World Bank and the IMF is more at the evolving the shape of the relationship when we're talking about the policies of development that should be designed at countries. So it's not just a relationship of financing, but a relationship of actually designing development policies at the government level. And there is, when we see the World Bank talking about a knowledge bank, it becomes very important in the design of these policies so that we are not just customers of financing, but also quality of finance. And quality of finance has to do with the long-term vision related to these policies. In the case of Egypt, as Minister of Planning, Economic Development and International Cooperation, and I call this a Ministry of Financing for Development, we put together what we called our narrative for economic development, reforms for growth, jobs and resilience. And there, given what Ngozi mentioned, the global trade system is also pushing all countries to think how can they promote their comparative advantage, how can they actually devise policies, structural reforms that make sure that they can stand out and make whether it's industrializing, localizing industries or increasing regional trade is something that can be used to safeguard against future shocks and actually create resilience. Everybody wants to increase more their tradable sector, push forward. We've had the debate about AI and whether AI is pushing countries' inequalities further. And the 4 points that were mentioned in the panel before when it comes to making sure that countries are actually benefiting from the AI revolution become extremely important. A few things to also take into account. The spending quality over cuts. This is something else that is very important. If there are savings from fiscal consolidation, how can we use those more for human capital, be it on the social spending side, health, education, so that we actually close that gap when we're talking to skills, which is much needed. The private sector is repeated once and again, how the financial resources that are scarce today can be used to actually create the needed blended element to increase more private investments into developing economies. This is one key aspect. And there are different sectors which might be attracted towards that. We have the very big renewable energy as one example. We have also elements related to some of the adaptation projects in different countries. And then another important aspect related to also medium-term planning. So rather than just looking at the resources to sort of stave off against a shock, also how can we push that forward? A few lessons that all countries I think have benefited from over the past 40 years. Macroeconomic stability is a necessary condition but not sufficient. Structural reforms need to be coupled with that in order to push the frontier of the economy. Social protection is an integral part of any program so that you can also safeguard against the future, and growth has to be inclusive. And then finally, the shared ownership between government and the public so that all these reforms can also be pushed even further is very important. And here comes the importance of communication, the clarity of the clarity of the message, the clarity of the reforms, and then finally sequencing of these reforms, the speed by which they can be done. And then in the world where we are into experience sharing, scaling becomes very important. I think IFIs today have a very important role in trying to chaperone or umbrella the experience sharing between different countries. We saw in the panel before regional cooperation is important, be it in trade, which we are seeing as a fallout of what's happening globally. But this is also something that is quite important going forward. So for those who believe in international cooperation, that is the only way that we will be able to face shocks together. Financing is not as much as needed, but there are different modalities of trying to think of how we can bring in more private investments through de-risking. And I want to maybe conclude by what the World Bank has been promoting, which is the different sectors to push the growth and jobs agenda, infrastructure and energy, when we're taking a look at healthcare, when we're taking a look at tourism, when we're taking a look at manufacturing. And I think these are consistent sectors that would help countries, but they have to be also designed at a level where both the biggest institutions that do lend a hand to countries, the IMF and the World Bank, it would be very useful to see that in the policy dialogue, be it in the surveillance under Article 4, or whenever there's a program, that these concepts are actually making their way into development plans at the national level, because any country that is achieving this at the national level is also contributing globally, and that makes all of us better off. Thank you very much.
Professor Knott.
So thank you very much for having me. Normally, one begins a presentation like this with the normal disclaimer, but I think in my case it's safe to say that my affiliation wholeheartedly agrees to everything I'm about to say. And I'm about to speak on the topic of emerging global architecture, and I will do so primarily from the vantage point of international financial regulation and the role that the Financial Stability Board and other standard-setting bodies have traditionally played here. Now, I think this topic is really a very well-chosen topic today, because the world is dealing with increasing geoeconomic and regulatory, unfortunately, also fragmentation. The world is in the middle of a reconfiguration of international relations, where it seems that we are a bit drifting away from a principles-based system toward one that is dominated by transactionalism. We're drifting away from a belief in win-win situations toward zero-sum games, and also away from a realization that at the end of the day we're all repeat players, toward perceptions of one-shot maximization. Now, luckily, today we are still discussing emerging global architecture. And as a matter of fact, if I had chosen the title, I would probably have chosen Emerging but Still Global Architecture. And that is because I do believe that global fragmentation has, of course, real consequences for real people. Many countries today are rearming. They are protecting their strategic economic infrastructures and strengthening economic national security, curbing strategic economic risks are, of course, logical responses in a world that has become a more unfriendly place. But if not properly managed, the economic cost of these policies could be rather high. Economic costs can, of course, be felt directly as the consequence of trade restrictions that Ngozi also spoke about. For example, through higher import prices, through market segmentation, reduced access to technology and knowledge. But fragmentation does not only affect the real economy and inflation, it also has implications for financial stability. weaker growth, higher inflation, and make it more likely that banks and other financial institutions will suffer from credit and market losses. Restrictions on the flow of capital and investments limit the ability of financial institutions to diversify their portfolios, and state-sponsored cyber attacks pose a threat to our financial systems. But perhaps the most important way in which fragmentation affects financial stability is when we, as an international community, can no longer find each other when faced with crucial cross-border challenges. And that is because the most important challenges to financial stability today are precisely these cross-border issues that we can only solve if we work together. And there are many such challenges. During the global financial crisis, policymakers around the world came together to respond swiftly and effectively. And that was possible thanks to the good relations among public sector financial decision makers, but also the solid international institutional structures that had been forged over the years. And in a fragmented world, I would argue that such a swift response would become at least more complicated. And that could prove rather costly. And after the global financial crisis, countries around the world assembled in the G20, they took the lead in hammering out a firm package of financial reforms, which was overseen by the Financial Stability Board and the Basel Committee on Banking Supervision. And that package was successful. It was successful in the sense that it transformed the banks from being shock amplifiers into shock absorbers. And during the well-known episodes of recent market turmoil in the 2020s, we benefited enormously from the restoration of bank resilience. That also came about in a reduction of procyclicality. Now, obviously, that financial reform agenda that was rolled out after the crisis had some unintended side effects as well. Sometimes one can liken the financial system as a sort of waterbed. You push on one end, and then, of course, the activity and the risks pop up on the other end. And today, there is a bit of an unlevel playing field. It has been also mentioned in the previous panel, between banks and other intermediaries. And that has probably been one factor behind the rapid growth of non-bank financial intermediation over the last decade. Now, just to be clear, when I talk about an unlevel playing field in resilience, I do recognize that resilience in the non-bank space is entirely different, or is very different from resilience in the banking space. So I'm not trying to copy a banking model on the non-banks, but I do think if you look at resilience as a concept, there is not a level playing field today. We have been working on it, and that is also necessary because NBFI today represent more than 50% of global assets, with still significant parts operating from the shadows. So here, its significant cross-border interconnectedness also requires that regulators worldwide work together on preserving market functioning and on safeguarding financial stability. So in the aftermath of the March 2020 Dash for Cash episode, the FSB, together with the IOSCO, put together a roadmap for NBFI reforms that essentially consisted of two strands of work. First, there was a need to strengthen the liquidity management practices within some, I would say, major players within this NBFI ecosystem. And so the NBFI and IOSCO jointly came up with additional sets of recommendations to better control the inevitable liquidity mismatches that exist within money market funds as well as within open-ended investment funds. But next to that, secondly, we also observed that there were a number of cross-cutting issues that played a role in amplifying the various spikes in liquidity demand that manifested themselves during these episodes, like the Dash for Cash, but later also the Archegos case, the commodity traders squeeze, the UK LDI mini-crisis. In all of these episodes, for instance, a lack of liquidity preparedness for margin calls was very manifest, as were pockets of hidden leverage that presented themselves in corners of the financial system where we had previously been unaware of it. So also here, the Financial Stability Board has put forward sets of recommendations to strengthen risk management practices and existing operating procedures, what we loosely refer to as the plumbing of the financial system, in order to achieve higher resilience. But as is the case with all forms of regulation, every piece of regulation is, of course, as strong as its implementation record. Recommendations alone, and I quote Andrew Bailey here from his letter to the G20, recommendations alone don't reduce systemic risk, but implementation does. And without timely and consistent implementation, the resilience of the financial system will be undermined, leaving it vulnerable to future shocks. And here I believe that the broadly perceived weakening of commitment to implement agreed reforms provides some cause for concern. A notable example that I think we all have in mind is the implementation of the Basel III framework, a cornerstone of global financial stability, whose implementation, as of today, remains incomplete, more than a decade and a half after the global financial crisis. Reform of global trading rules continue to be postponed. Now, to be fair, implementation of global capital standards for banks has never been completely aligned, and it has always ended up a little bit more on the side of deference than full harmonization. As we were, for instance, reminded by the Silicon Valley Bank failure, the US has always taken the approach to only apply global banking rules to less than a dozen internationally active banks, whereas, for instance, the EU, on the other hand, has traditionally applied the Basel standard to all of its many thousand banking institutions, but that then often came at the cost of watering down requirements for SMEs and sovereign borrowing. So all in all, a situation is developing where the establishment of a regulatory equivalence, and which I believe is a precondition to maintain open and mutual access to each other's capital markets, that precondition has not always been as straightforward to establish as we hoped for. A further example that I can mention in this context is the regulation of crypto assets and stablecoins. It has also been mentioned earlier this morning, where I believe also that we are fast approaching a tipping point. With the introduction of the crypto ETFs, the barriers for retail users have now dropped significantly, and interlinkages with the traditional financial system continue to grow. A number of incidents over the recent years have highlighted the vulnerabilities of the crypto asset ecosystem. And these vulnerabilities also require a consistent international regulatory approach based on the principle of same activity, same risk, same regulation. If we do not work together in this space, then what we risk is a race to the bottom dynamic, where crypto dealers and stablecoin issuers might be located in the least regulated regions, but spark problems elsewhere in the world. So for us, central banks, and also for international institutions like the WTO, the FSB, the IMF and the World Bank, geoeconomic and regulatory framework, regulatory fragmentation is to a large extent a given. We have to deal with it, and then of course the question is, how can we deal with it? Well, to give you my 2 cents, I think our task as central bankers and as financial regulators is first and foremost to simply try to limit the economic costs of political fragmentation as much as we can, and the typical answer is then to bolster resilience within the financial system. But we should do more. We should also continue to speak up for the international financial rules-based order that has brought us the stability and the prosperity over the decades, by pointing to the economic and social cost of protectionist and fragmenting policies, and by staying committed to a constructive international dialogue, constructive international working relationships, so that this international regulatory framework can continue to function as best as it can. But secondly, and maybe this is a little bit also open for the discussion, I believe we should also have an open mind toward potential improvements in the way global coordination functions. The crucial role that international and independent international organizations at its very core play in this is hopefully undisputed. But independence comes with strict adherence to the mandate, combined with public accountability and global representativeness. On the political side, the G20 is probably the only forum that can claim such global representativeness. But has its delivery truly been proportional to its resource deployment? And most importantly, in such fora, have we really been talking to, or have we mostly been talking at each other? Well, these are just a few questions that, in my view, warrant some further reflection. Because after all, the global economy, its financial system, its emerging but still global architecture are a little bit like Hotel California. You can check out anytime you like, but you can never leave. I thank you.
That's a reference older than 1985.
76.
Yes. Professor Rostow.
It's a pleasure to be here, Raghu. Thank you so much for inviting me. For some years now, it's become apparent that we are at the end of a remarkable period of globalization that began with the end of the Second World War and accelerated after the end of the Cold War. And if we look around, we see that this globalization, aside from the remarkable economic progress that it's brought around the world, has led to a growth in the international architecture, which both supports globalization and has been caused by globalization, has been made more necessary by globalization. This architecture is under pressure, most evidently right now from one of the countries that has been its sponsor, that has benefited from it, and which remains probably the most dynamic and successful economy in the world. I'm referring to the US, although China is trying to catch up through a different state-sponsored model. But there are other pressures that are growing, and they are present really in all countries. It's important that we keep that into account. Now, what does this architecture look like? One key element has been the flexible exchange rate system, a convergence on some best principles of policy practice, central bank independence, sound fiscal policy. These have really been much more widely accepted than they would have been decades ago. And Kristalina pointed to this in talking about the greater resilience of emerging markets. I view this convergence in views as an important element of the architecture. There's obviously the global financial safety net with the IMF at its center, as we always liked the G20 to repeat when we were at the IMF, but also regional arrangements like Chiang Mai, central bank swap networks, not all centered on the US. China has certainly contributed in this regard. There's the World Trade System. The WTO is at its center. It's not a perfect framework with perfect rules and perfect procedures, but it's still immensely important. And as Ngozi has pointed out on many occasions, most of the world still trades on the basis of World Trade Organization principles, the MFN principle. There are also regional trade agreements which are likely to become even more important in the coming years in the face of US tariffs. Klaas just reviewed financial cooperation. This is something that really grew up after the advent of flexible exchange rates, starting in the mid-1970s with the Basel Committee and the Financial Stability Forum, which became the Financial Stability Board, IASCO, and also the Financial Action Task Force, among several other elements. I would mention the important work of the OECD on tax harmonization. Currently, the OECD is thinking about best practice in AI policy, which is an incredibly important topic going forward. The multilateral development banks are critical for the architecture. The World Bank, the regional banks. I would mention here also the AIIB. There are other elements coming into the picture. Multilateral fora like the G20, the G7. Let's not leave out the BRICS. These may not always deliver as we might expect or as they might have on past occasions, but they're very important for international coordination on major common resource problems and just exchanging information. Finally, I would mention a key aspect of the global architecture, which is the dollar and its key role as essentially the global currency, the closest thing to a global currency as we've ever had or are likely to have again. Now, if you look at all of these elements, you can see some pluses. You can see some very obvious minuses. And I think these are all challenges going forward. If we look at the global financial safety net, it's immensely encouraging that the 16th quota review is being supported in the U.S. administration's fiscal year 2026 budget. This is a hugely positive development, but it also reflects intensive negotiations within the IMF itself, goodwill efforts by China and other countries to come up with a broadly acceptable package. As far as the World Trade System is concerned, the U.S. has basically abandoned the MFN principle, negotiating a series of bilateral deals with different tariff rates for different products and different trade partners that I think is going to be very, very costly, and very costly particularly for the U.S. itself as businesses try to comply with the bewildering set of paperwork requirements that all of this is going to entail. The OECD's very promising work on tax reform has been abandoned by the U.S., and it short circuits a very promising project that might have limited the race to the bottom in corporate taxation. And as far as the dollar is concerned, and I've talked about this elsewhere, but if you look at almost every pillar that supports the dollar's role, it's under threat. I would mention just a couple. The attack on central bank independence in the United States threatens a key pillar of U.S. price stability on which the world relies when it uses the dollar in the many, many ways that the dollar serves as vehicle currency, reserve currency, invoice currency, and funding currency. I think that fiscal trends in the U.S. are very worrisome for the international status of the Treasury's liabilities, which are also a key pillar of the system. So I think these are all very worrisome events, and events that will be very hard to reverse ultimately. The tariff war may have settled down for now, but given the fiscal developments in the U.S., it's hard for me to see that even future governments in the U.S. of a different party will be in a political position to significantly lower tariffs. Revenues will be needed. Lowering tariffs will bring the need for other taxes. Raising taxes in any sphere in the U.S. is incredibly difficult. So I'm sorry to say that we're not going to go back to the free trading U.S. that we've seen in the past anytime soon, and I think that's a great pity. Axel earlier talked about the conflict between, or the contrast between the fragmentation in the trade sphere and what has happened in finance so far. In some sense, finance seems to have been immune from the kind of pressures on trade which are in the headlines every day. I don't believe that can last, frankly. I think that trade fragmentation, which is ongoing, which has been ongoing for a while, as documented in the IMF's research and other research, will ultimately, inevitably lead to more financial fragmentation. One conduit might be the lower appetite to contribute, to cooperate on financial regulatory measures at the global level, in the Basel Committee, through the FSB. If I look at the US push in the stablecoin sphere, that I think has a lot of capacity to undermine the work of the Financial Action Task Force going forward. So I think there's a lot to worry about on this account. Now, it's not enough to simply bemoan all of these developments and talk about developments in the US. I think all countries need to look in the mirror to some extent, because the pressures that have led to the political developments here in America, we see them in many other countries. And they stem from factors, some of which are related to globalization, some of which are not. Greater inequality, greater regional disparities, greater unevenness in economic development within countries that may even accelerate as we're facing the further pressure of technological change due to AI. Rania gave an excellent rundown of the types of domestic policies that I think are needed to support growth, but also to support further retreats from globalization. All is not well domestically. And if there was a negative mood at the IMF, I think it's because of the realization that, at the IMF World Bank meetings, of the gravity of the task that policymakers face in the domestic sphere, not just the international sphere. I'll stop there.
Let me take a big round of interactions, and then I'll open to the public. So there was a discussion a lot in the first session of global imbalances, which I thought was interesting because I do associate them with Professor Oswald. And there was also an invoking of Adam Smith, of the advantages of countries of being access to larger markets to be able to take advantages of economies of scales and improve productivity. But this world of Adam Smith is a world that implicitly was always a world of atomistic players, and also perhaps implicitly a world of private agents. It was not a world of big government agents subsidizing activities, or a world where materials, for example, were concentrated in few countries. I still see this world, the one that we're evolving to, one that is very complicated for us as small countries. I usually like to raise the flag of us little, small open economies, which benefited in many ways from the international financial architecture, and in particular from institutions as the WTO. So you did mention the way forward, but in particular, what type of advice would you give to the small open economies to deal with uncertain times? And believe me, I can live off bananas and coffee, but I don't want to.
Well, obviously, we have to look at the real times we live in. But what I said in my remarks made it very clear that, I spent some time reminding people, because they forget, what this architecture, global trade architecture that was built 8 decades ago, what it has done for the world. It made rich countries prosperous and consumer goods cheaper,
yes, we don't deny that there were some aspects of that development that didn't benefit everyone, you know, that there are poor regions in rich countries and people who did not benefit. We should recognize that. But I think also if, let's not lay everything at the doors of trade. You know, active labor market policies, if in certain countries, might have helped if they'd done that. I mean, we look at the expenditure on such issues across the globe and we find differences. Technology has also been at play and so on. So often trade is sometimes blamed for things. It's guilty of several things, but even those it's not guilty of is blamed. So, but the point I'm trying to make is that, look, on the balance sheet, it has done a lot of good for both rich and poor countries. And so my answer to you is yes, we need to, you know, stick to what has proven to be a good benefit for most of the world, both developed and developing today. But we need to fix parts of it that don't work. We also cannot walk around with blinders, you know, acting as if it benefited everyone equally. There are people in rich countries that lost out. There are poor countries that don't feel they gained enough. How do we fix it? And I happen to think we can, because there are exciting opportunities in trade today, which developing poor countries can benefit from. Digital trade, for instance, green trade, and so on. We need to diversify trade more, bring value chains to those parts of the world, whether it's poor regions of rich countries or rich poor countries, where that didn't benefit in the first phase. We actually have a term for it at the WTO. We call it re-globalization. We need to reimagine globalization. We cannot have what we had in the past. It has to be rethought. But that doesn't take away from what open, you know, trade and open economies, you know, what they're saying. We need this trade. So countries like yours with a trade to GDP ratio north of 50%, sometimes north of 100, are making that case today at the WTO and saying, we need to come together. They call themselves the middle economies. We need to lead the reform of the system to make it better, lighter, more flexible, allowing more flexible coalitions. We need to solve the problems we didn't solve in the past. Excuse me, WTO is made up of its members. If we saw that certain rules were not working, certain agreements needed to be modernized, the members should have been trying to do this. I know the United States feels frustrated. It says it tried to do it and it didn't work. Well, okay, this is the time.
Thanks. Let me follow up on that to Minister Rania. And now that I work at an international financial institution, I am now worried about how we, international financial institutions, can deliver better outcomes to emerging markets and developing countries. And so in that, one is for us to try to get together, but two parts of this question. One, can we, middle children, and I am a middle child, so reform a system in a world that is now dominated by the uncertainty of the advanced economies? And second, how can we have a good balance between ownership that you mentioned, but also acknowledging that many times countries do get into political processes that are not the most conducive to growth and development, and the tough love that Kristalina mentioned?
Well, thank you very much. A few things. First, what's happening globally pushes us to reform faster. If we don't, we are going to lose more. So if I go back to a few words and we put them together, policy is important. Institutions that support these policies, and I thank Professor Obstfeld, I mean, central bank independence, the disentanglement between fiscal and monetary policy, flexible exchange rates as absorbers. All of these, the institutional setting that supports such policies becomes key. And trying to always remember that they have delivered in the past, when we take a look at the examples in Latin America and other emerging markets, and so we should not leave them behind. International institutions are there to provide support when needed, but countries have to do their reforms, have to own their reforms, have to publicize the reforms, because that's the only way that the medium to long-term dividends will continue to come. So this is something I really believe in as a policymaker, and also being on the other side and discussing, with international institutions, the technical assistance around that, the country examples around that. How can you design policies that make sense, are coherent, are well communicated, and at the same time implemented in a way that also pushes accountability. So these are real. They are not just theory. This is what will deliver when it comes to human capital. This is what will deliver when it comes to lower prices or lower inflation over time. Then comes, all of us want to grow, and we know that growth at this stage is going to be very much dependent on the private sector being there. So how can you convince the private sector to come to a country? It has to have credible policies. It has to have predictable policy. It's not about today, it's about tomorrow. So I go back to policies which are well articulated, well understood by the public, by the markets, because there's a lot of gain there. In our case, and I take Egypt, we have never lived in a tranquil time. Tranquility for us is a couple of years. There are always headwinds, whether it's a geopolitical situation or there's a shock that affects terms of trade, etc. So the only way that you are able to create that resilience is to always, continue reforming. And it's an unfortunate reality that reforms have no ceiling or have no end. As long as we live, we will continue to reform. And you want to make sure that over time you do not get into a situation where there's reform fatigue. So you always need to update your matrix. You always need to update your objectives. You always need to put it within a context of development objectives that the people can associate with. So when you're doing fiscal consolidation, which may be very tough, removing subsidies, for instance, you know that the savings are going to go to better health, better education, to social protection programs, which are well communicated. So as much as we sit down and try and push the ball on the international institutions, I think that countries have to have, and when I say country ownership, it's your own program, it's your own development trajectory, and you need to articulate it well. So that's to me, the safeguard as much as possible. Of course, shocks are not going to be, they will come, and they will come in different ways, but the only way to create that resilience is through well-articulated and have, buy-in as much as possible. So these are to me convictions which I believe in, and I think that the fora around the IMF and World Bank meetings is a way for whether it's the coalition of finance ministers or planning ministers or central bankers, everybody is trying to push for well-articulated policies, because that's the only way that we can save ourselves from future shocks. So I would say policy, institutions, private sector, and all of this is to create growth at the least debt burden possible.
Can I add something?
Yes.
Because this is I totally agree with Rani and what she's saying. If you have, these middle powers as well, confident, you're doing your domestic policies the way you should to make sure you can absorb the shocks, you also can get together to have agency. In other words, if you're good and confident in what you're doing inside, perhaps coming together, to try to push for reform in the global institutions is what you should be doing. It shouldn't always be the case that, the large economies or the large powers are not acting, therefore all is lost. And sometimes I see that attitude, and I think it should really change. We have this coalition of 14 countries at the WTO, led by Singapore and Switzerland and UAE and New Zealand, coming together and saying, we want to have agency, we are doing our homework inside. How can we get together? We've been talking to the EU could also help lead this. So I agree with you, but can we have more courage once we've done our homework to say, okay, let's get on with it, okay? The world is moving. We can't always wait for the large powers to come and signal the way.
Thanks. I like all the countries that you mentioned. They're my type of countries. So, but you did mention the role of Europe, and you did mention that we need to improve global coordination, and there's also this sense that this needs to happen fast. I was in Europe 2 weeks ago, and fast doesn't seem to be a word that characterizes reforms in Europe. And I have to say, and it was mentioned in the previous panel, I did feel some risk aversion, a risk aversion of a world that is changing in many ways. And perhaps this happened because I was in a conference about digital payments, and was interesting for me to see that this revolution in digital payments had happened in India, had happened in Brazil, had happened in the emerging markets, but Europe was like stunned, like still figuring out how to do it, and the discussion of this first needs legislation at the EU level. So, to you, and since you respond to yourself, maybe I can ask a little bit more of a blunt question. Can Europe lead and be the anchor of this brave new world in general, but in particular, if it's not leading the technological race?
Whoa, that's a very difficult question. I mean, if you go back to the root, why do we have Europe in the first place? And your 40 years is I think, a very nice time horizon, because I think European integration really got accelerated in the 1980s. That was precisely because I think a former European leader once quipped that Europe has only two sorts of countries: small economies and countries that are beginning to realize that they are small. And that, I think, has been an important driver for us to come together. The simple law of the numbers is that, okay, you can have a much higher GDP per capita than in the rest of the world, but at some point you know that there will be convergence, even if it's incomplete. And if population growth is elsewhere in the world, then the mathematics is pretty simple, that your relative weight in the global economy has only one direction to go. It has gone in that direction, and also it will continue to go in that direction. That's in my view, the law of the inevitable large numbers here. Can you then still have a leadership role? That is the question you ask. Well, I think external strength, external relevance is probably, to begin with, a function of your internal strength and your internal coherence. And there is reason for concern there. If you look at the list of items that also Christine mentioned in the previous panel, that we have an internal market in the name, but we don't have it in reality, and that the obstacles that we raise vis-à-vis each other are of similar size than the trade barriers that now, for instance, the US administration is imposing upon us. That if you look at the cross-border banking activities and the cross-border banking assets in the EU, we have a lot less banking union today than we have in 2011. We centralized our institutions, but banks have withdrawn from doing cross-border business. Well, we don't have a capital markets union, on which I can also elaborate for however long you want. But I think if we want to continue to play a role, we have to fix our internal inconsistency first, because otherwise you lose also, I think, your external relevance. Now, on the technology and on the digital, let's say, revolution, it is clear that we lost out on the first phase. We were not part of that. But I still believe that if it comes to AI, by adopting AI, you can still benefit from the productivity boom. So I don't think it is too late. But this issue of slow-moving, that politics is too slow, actually, for the speed with which changes in the economy take place, yeah, that's clearly an issue that is also haunting us. The number of recommendations of the Draghi report. Politicians will never solve a problem that they don't have. So first, there needs to be a sincere sense of urgency. And you sometimes feel that if the issues that have to do with longer-term
potential growth, that the urgency that comes out of that is less than when you have to deal with an acute crisis like in 2011, 2012. I think a lot of people in Europe, they are not satisfied, of course, with the growth potential, but they don't feel that we are really in a crisis. And that lack of urgency, how you can bring about change, how you can bring about reforms without that strong external push, that I think is the challenge.
But are you positive or negative?
Oh, I think at the end we always came together in Europe and we did what we have to do. But it was a little bit like Winston Churchill's quip about democracy after all the other alternatives have been exhausted.
And a last question to Maurice. Your speech was a little bit not optimistic, to put it lightly. Being my Latin self, I usually like to see a positive light somewhere. The international financial institutions do need reform. I do think they have done great things, but we all acknowledge that they do need reforms. So if we go back to the decade of Hotel California, the early part of that decade, those were complicated times. Those were uncertain times. I would say that one of the outcomes of those uncertain times was the movement towards flexible exchange rates, which I actually do see as a benefit. I do see Latin American countries that embrace flexible exchange rates to have managed to improve many things. It was also true that they reformed banks. This was also the outcome of the 80s crisis, so on and so forth. And I do agree that in many things the US is not going to go back, but do you think there is a chance that the current environment can bring some positive benefits and improvements to the international financial organizations? And if the answer is no, that's also fine.
No, there's always hope, right? And we should always be trying. If we go back to the 80s, one of the stories of the 80s that people refer to today is the Plaza Agreement, the start of international coordination among at least the G5 countries. I fear it's not really a template for where we are now. And I think if you look at what happened then, you can sort of see what some of the big differences are. Now, first of all, similarity. The U.S. had a huge current account deficit. Germany and Japan had surpluses. The U.S. believed that their deficit was due to excessive saving, underconsumption in Germany and Japan. Germans and Japanese believed it was due to fiscal profligacy in the U.S. So, that's a diagnosis, a clash of diagnoses that isn't helpful, but the dollar had appreciated massively, and everyone agreed that it had to come down. Germany and Japan were also growing relatively quickly then. They were doing well. There was a strong desire among all parties, this is when the G5, to prevent protection in the US. There was a lot of push in Congress for protection. And now, in contrast, we're leading, the US is leading with protection. There was also the idea of being at the beginning of a period of cooperation that I think was important. It was the Cold War, and there was no dispute that the US security umbrella would be there and was essential. And finally, there was no China, so you didn't have to bring them in to coordinate. There was Japan, but they were very interested in coordinating, and they had been already subject to severe trade pressures from the US. So I think on the whole that was a big success. But when you look at those conditions, you realize that we are not where we were then. The dollar is not obviously overvalued. The U.S. actually has stronger growth than its industrial country peers. Protection has already happened. There's little prospect that the U.S. is going to promote cooperation. Instead, it's been going around the world striking bilateral deals based on coercion either in the trade sphere or implicit threats modifying its security support. And let's be honest about what's driving these deals. China is a big player. You're not going to have a functioning world economy unless there's some accommodation of China. It is the biggest trader in the world now, and more countries have trade relations with China than any other country. So that's a problem. How does this evolve? I sort of fear, but I expect that we may move to a system where, there are middle countries that are not choosing a camp, and that's sort of the hopeful thing. If it's a large group, and if they coordinate together, if they can establish free trade among themselves, that's going to be very good for the global economy. And then, maybe the U.S. and China accommodate themselves more to that reality, and the U.S. maybe comes to its senses about trade. And if you look at polling data in the U.S., and I think we have to be very skeptical of polls because they depend on, how the question is asked, what are the circumstances, what's the context. But for example, the Chicago Council on Global Affairs shows favorable attitudes toward trade rising sharply over the last few years, not just during the Trump administration, but a relentless climb. Why that is, I can't explain. And if you ask the question as, do you care more about job creation or competitiveness, then people say, well, we don't like trade as much. So it's delicate, but I think there is a latent appreciation out there, maybe especially after the price increases of recent years, that trade brings benefits. Now you said I was pessimistic. The area where I'm actually most worried is not really about the global architecture, but it's about global climate. And I really worry about how this ongoing failure to really rein in use of fossil fuels and emissions is going to affect conditions globally. It's going to have a very uneven incidence globally. Poorer countries are going to be much more affected. Migration will be affected. And if we look at some of the main causes of the rise in populism in coming years, it is migration. So this, in some sense, worries me more than everything else we're talking about. And I think it's, how we can get this back on track. That's a big problem. Again, China seems interested and acknowledges the reality of this problem. A large group of middle countries could work on this. Maybe that could help. But I think at the moment we seem on track, unless there are some remarkable technological developments for some rough times ahead, driven by these natural phenomena.
And if I may, the underlying issue, of course, is a lack of willingness to take the external effects of one's policies into account. I mean, most international standard setting and international policy coordination is about trying to bring countries to internalize some of these external effects. And that willingness is lower in a world of transactionalism. And climate, I agree with you. That is going to be a main victim of this.
It's not only externality; it's also the distributional burden.
Yeah.
It's really unhelpful that the multilateral development banks are being pressured to downplay climate as an issue of policy and research when it's so important, and we will see the consequence over the decades.
And
Can I just say on that, I think there are one or two central bank governors here who were at the IMFC meeting. It was rather encouraging that there was beginning to be a pushback on this. And Lesega, the governor of the Central Bank of South Africa, is there. He was one of those pushing back and saying these are macro-critical issues. I mean, Christine Lagarde started that, and many came up and, unlike what I'd heard before, and really pushed back. I don't know if you want to say something, because I thought that was pretty remarkable.
And in my previous job, that is called a cold call.
not sure that I will add much. Just one thing to say, in trade negotiations, you can walk away from your trading partner and you can find another trading partner and you can cut a deal with them. With climate, when you walk away from the negotiations, the whole planet gets warm and we will all suffer. And so it is very important that we actually stay the course on the climate issue. But to Maurice's point about pressurizing the MDBs, it's not just the MDBs, even the IMF gets to stay in your lane. But the point here is that this thing has got significant implications for the macroeconomy and for the financial sector. And one of the big things that is emerging now is the gap in insurance, that there are a lot of climate events now that are basically uninsurable, and countries are going to suffer significantly as a result of that.
And I think with that, let's open up for comments. Yeah, I had seen that hand there first, and then Guillermo Ortiz here. And please introduce yourself and the affiliation.
Yeah, thank you very much. My name is Frank Vogel. I'm a professor at Georgetown University and founder of Transparency International. My question is very simple. Secretary of the Treasury Scott Bessent said in a statement this week to the IMF, strong commitments to governance and anti-corruption and effective safeguards must underpin lending programs. I encourage all my students, Ngozi, to read your speech in 2007, so really primarily addressed to you. Can we have an emerging global architecture where we totally ignore corruption and rising illicit finance? I say ignore because none of those issues was raised by the leaders of the IMF or World Bank in this week's discussions, to my surprise. Thank you.
The answer is no. Short and simple, we cannot, because ultimately rising corruption and lack of governance and all the illicit financial flows and all the issues you raise, Frank, only undermine and corrode and corrupt the system. So we cannot. I think the issue why you don't hear that, it's not because they are not important. They're crucially important. It's part of what Rania was saying. Part of what we need to do domestically in some of our countries is also to work on that internally. But I think globally, there's so many issues now on the global stage that it's confronting policymakers. That maybe that one is not gone off, but it seems to have taken a bit of, what should you say? It's not that it's fallen off, but it's not as prominent as some of the things. When you see people are worried about maybe is the global trading system going to fragment with very big costs, then that seems to come. Is climate change going to fall off the calendar, not be talked about? So I think there's so many issues at the moment that are confronting policymakers that they're just trying to focus. And it's not because it's off their agendas, at least as far as I'm concerned.
I just wanted to say that on illicit capital flows, OECD and the UN with countries are working very strongly on that. So maybe it wasn't featured in the annual meetings, but it is ongoing in our dialogues with the UN and OECD, which are taking the lead. And then just on climate, there's always, currently there's a way to package it, and they're called smart investments. So that's also a way to say that they're still very urgent and we can get financing for them, because if anyone's doing a renewable energy project, that's a smart investment. You can bring in private investments into a country if you're going that way. If you're doing water desalination, it's another way. So I agree with the governor of South Africa, but also given the global context, you know, the way you package things can help in trying to push the needle forward.
Thank you. My name is Guillermo Ortiz, and I'd like to ask a kind of a summary question. Ngozi mentioned Thurman's speech at the Per Jacobson regarding multilateralism. Which would be the three elements that are necessary to restart a productive dialogue on this issue, and particularly on the World Trade Organization. We have been all over the place, but perhaps it's time to name three of the concrete, not only substantial, but also procedural questions that are needed to restart this dialogue.
Should we pick up a couple questions? And yeah, I saw your hand also. Yes, let me take this, and then I'll send it to the panel.
Thank you very much. Excellent panel. Joachim Nagel, Deutsche Bundesbank. Brave New World was mentioned. I attended the same conference in Frankfurt. And this famous book with the title Brave New World comes with a warning connotation. We shouldn't give in when truth and freedom is in danger. And that brings me a little bit, now I have to find the connection to the question I would like to raise to my friend Klaas. Taking the assumption that the US, and I attended many, many meetings over the past couple of days, pushes ahead with deregulation, taking a European position, can we afford to maintain a robust stance, or have we more or less, or is that a necessity that we have to change and following the same path? Thank you very much.
Thank you very much. Professor Opfeld mentioned that the dollar is under threat from several quarters. One development that could be added to that list is the geopolitical weaponization of the dollar and the financial system, for want of a better phrase. How do you assess this possible risk to the dollar, and how might it affect the future evolution of the financial architecture?
Let me open to the panel and take the ones that were either directed to you or you have something to say.
Okay. Well, Guillermo, thanks for your comments. I think first, to restore the faith in multilateralism, there has to absolutely be acceptance of the need for reform. We need multilateralism, for global public goods issues. There's no two ways about it. But also, we have to admit it's no longer that many of the organizations, to be fit for purpose, need to be reformed. And that's what I'm saying at the WTO. We accept. This was one of my criticisms. We should have been reforming all along. And reform is not stop, do it, and then, 10 years later. You have to keep up with the reforms. Every finance minister knows that. If you don't keep reforming, you're in trouble. But what are the specific elements at the WTO? So first is the acceptance by everyone. And believe me, with 166 members, you talk of 27 at the EU, it's like herding cats sometimes. They shouldn't hear me say this. But 166 members have to accept that we do need to reform. And most of them now do. But you need to build a level of convergence. And believe me, there are some who don't, who think the status quo is just fine. And it's not. So that's the first element. And then what are the specific issues? First is the way we make decisions, governance and institutional issues. The governance system is getting in the way. We have a consensus decision-making system, which is wonderful. We want to keep it. But the way it is practiced is more like unanimity, like I said. And so you have a veto. We need to find out how do we have a practical application of consent. So I think if we change that, that will enable us to move to the next. How do you get a more flexible organization that allows coalitions of countries, members, to come together to make agreements that may be more suitable to the times? AI and digital is moving. Green trade is 2 trillion. If you want to have agreements that underpin these things, how do you do it? So that, then 2, 3, there are a lot of complaints about unlevel playing field and lack of transparency. I think we have to grapple with that. Issues of subsidies that may not be transparent. We need to think about this. Barriers to trade, I think. And then finally, we have a dispute settlement system, which is the only one in the world where cases in trade of one member against the other are judged on an equal basis. That is also not functioning. It's functioning, but not as well as it should. that has to be reformed. So I just mentioned 4 elements, very specific, very clear. We have to work on them and get them done.
Maybe on the international institutions, I think there's been progress compared to maybe 18 months ago. And I give some examples. You see a more consistent message between EBRD and the World Bank and EIB and African Development Bank. So there's some movement. And with the IMF, are we finished with the reforms? No. But there is more consistency when it comes to trying to streamline the time they take to push certain financing. The different instruments for encouraging private sector to come into countries on a concessional platform. The introduction of debt swaps, which was not there a few years ago. We need to do more. The tickets need to be bigger. So I wouldn't want to leave by saying everything is so gloomy. There is a goodwill, there is a commitment to reform. I think, as Ngozi mentioned, we need to be more vocal on exactly what is it from the global developing economies or South, what we need. And then everybody talks about triangular cooperation, but we have not seen it being implemented, and that's where the experience sharing and things that work domestically in one country, you can very quickly replicate somewhere else. So we're not, the word triangular always comes up, but there has not been a modality to actually see it implemented. So I would say that...
so the minus, that is that they gave us time, so we're in -2.
Oh, okay,
Not
so
that we have 2 to go.
I'll
Sorry
stop
about
there
that.
and say that,
So,
there are some positives that I see.
There were questions for the last 2 panelists. They shouldn't do that because then we think we have more time. They should just set it on 0.
Okay. Joachim, very good question. I think my answer would be, it depends. First of all, we have to see what really will come out of the US. We don't know. We don't know. So, and part of the criticism on regulation here also has to do with local community banks and sort of more localized ways of finance. And there, of course, the level playing field issue is a little bit less urgent than, for instance, in the trading book. There, I agree, you cannot have a deviation. You have to have a global regime, since a trade can also be booked anywhere on the globe. I do think that deregulation is clearly something else than simplification. I also think that on the European side, there's a lot we can do by making the regime better accessible and less of a burden while maintaining the same level of resilience. And then finally, I will come back to what I also mentioned in my introductory remarks. There is this concept of regulatory equivalence. The US banking industry will also want to continue to have access to EU and other banking markets in the world. If there is a significant deviation in a downward direction because of a deregulatory push that is not supported elsewhere in the world, then at some point this will have consequences for regulatory equivalence, and that is not in the interest of, I think, the US financial system, and therefore also not in the interest of the regulatory bodies and the administration overseeing the financial system. But obviously, I don't want to downplay it. It is going to be an issue. It is going to make my successor's life more difficult.
Yeah, on the question of the dollar, I do think the U.S. administration has shown a greater willingness than past administrations to use economic tools and other tools for international coercion, and the dollar's position offers ample tools, and I don't see why we wouldn't expect those to be used. So I would think that countries would try to protect themselves. Just on Joachim's question, if I could intervene also, Dirk Schoenmaker had this concept a few years ago of the financial trilemma. You can have an independent prudential policy, you can have openness to financial flows, you can have financial stability, so you can have 2 of those, but not all 3. And I think that's the right framework for thinking about where we might go.
And on that note, let me thank the panelists and everyone for being here.
Thank you. I think all it remains for me to do is first thank the panelists, both in this panel and the previous panel, for giving us such a wonderful treat. It was great to hear all of you, to hear frank opinions from the entire panel. And also I want to thank our hosts, the Inter-American Development Bank, especially to Ilan, who couldn't be here. He has very important private engagement, but also to all his staff for all your support and efforts to make today successful. And thank Laura and Axel for being such wonderful moderators. So we appreciate all of you joining us. We have a reception in the back. We hope you remain engaged with the group of 30. We have certainly continuing events, especially the banking seminar next year in Bangkok, Thailand. Hope many of you will join us there. Thank you very much, and please, let's go to the reception.